Hey everybody, welcome back to the Econ Playground. I'm Marcus again, and I'm here with two special guests. One of them who's been on here before, Tegan Truitt, who I had on about a year ago to talk about Michael Polanyi. And he's now with me at George Mason University studying in the PhD program at the studying economics with the Mercatus Center. But also we've got Matt Kelly, who Tegan and I met over the summer at an IHS conference, and he's studying finance at the University of Texas at Dallas. And and he's further along in his PhD program than us, so he's got some really cool topics that we talked a lot about over the summer, and we wanted to keep talking about more. And I haven't been able to stop thinking about some of this stuff since we first chatted about it. And so, but what he's going to talk to us about today is a little bit of stuff about Frank Knight and uncertainty, just to start us off. But also, we're going to get into stuff about Gödel's theorem and complexity economics and how that could talk to the way that we do institutional theory. So, yeah, how about that, Matt?
Yeah, thanks. thanks for having me on, Marcus and Tegan.
No
and I actually I really enjoyed listening to the conversation you guys had about Michael Polanyi a while back after you sent me a link to it. So I'm a finance PhD student at UT Dallas, and I study uncertainty and Knightian uncertainty, and I do that in basically like the context of asset pricing. For the most part. So, in asset pricing is sort of the field of finance that tries to model and explain, why the price of some asset is what it is. What we tend to do there is talk about how characteristics of different firms and characteristics of the probability distributions governing returns, or the probability distributions that returns follow or seem to be drawn from, maybe it's one way to put it, how investors care about the variance and dispersion and expectations, and the characteristics of these distributions, because the idea is, people care about risk, and but basically, asset pricing is basically just like, it's just like microeconomics for where the only goods we care about tend to be this like homogeneous consumption good that you can get in time period 1 and time period 2, and it's all about intertemporal consumption. Is kind of how people tend to look at that. So you just think of like an asset as delivering this payoff that is denominated in some numeraire, and so asset pricing people, we try to model the prices of assets based on the characteristics of the distribution of payoffs that some assets associated with. And there's probably a better way to put that, but that's my perception of it. And so one sort of like one thing about that, when I'm talking about so we want to talk about how a probability distribution, how people care about probability distributions, right? Some assets deliver a very reliable certain return. Other assets are riskier, right? And the way you can think about that is that the probability distributions that you would use to describe returns of these two assets, one being safe and one being risky, they look different. But typically, what we do is sort of assume that those distributions are known, and that is and
known the same way to everybody.
Yeah, known the same way to everybody. And like this is kind of so a lot of this is like the rational expectations framework, where it's the same kind of modeling problem I've been talking about, but the assumption is that, well, the agents within the economy, even though an econometrician might be uncertain about what these probability distributions really are, the assumption is made that agents within the model, they know what those distributions are, and they form expectations rationally, meaning in that context, meaning they form those expectations with like near perfect knowledge about what the distribution is. So the rationality and rational expectations has probably more to do with like knowledge of the future than it does about transitivity and completeness of preferences and whatnot. But this assumption, right, is sort of widely recognized at this point, that we would need to relax that assumption in order to get more accurate models of asset prices. Lars Peter Hansen is an economist from University of Chicago, Nobel Prize winning, total genius dude, who writes about this a lot. And what he sort of came to was that a lot of the models in asset pricing and finance, they're very intuitively pleasing to a microeconomist, because the idea is very straightforward. People prefer more consumption to less, and they like consumption now a little more than later. And people prefer safe, meaning reliable, payoffs. If you buy an asset, you want one that has a reliable payoff as opposed to one that's
generally are risk
risky.
averse.
Yeah. People are generally risk averse. So like these propositions aren't all that controversial, probably. It's like to to somebody familiar with micro. But so in asset pricing, a real kind of like cornerstone is like consumption-based asset pricing model, where the way that you think about how investors care about why people would buy one asset over another. The idea is that well, people care about consumption, and people will pay a lot for an asset that delivers a return, delivers some payoff to them in a state of the world where their marginal utility is low. Their marginal utility is high, meaning that their consumption must be pretty low. So meaning, right, you would pay a lot for an asset that delivers you a payoff in, say, a recession, or at some time when you're you're already not doing well. If you lost your job, so these ideas are basically what's used to kind of say, well, people prefer that asset over some other asset because
so like someone that just lost their job would be more likely to buy a lotto ticket or something like that.
Oh, well, like maybe because they're sort of like what have you got to lose, right?
Yeah.
I think the idea is more like this. Like, it's kind of hard to explain why somebody would pay so much money for an insurance policy, let's say, right? Because it's like, in expectation, you shouldn't make any money on an insurance policy, right? If it's priced correctly, then it should be just like your premiums. Nobody is like, quote unquote, like making profit on an insurance policy is the idea, right? The insurance company would just charge you the actuarially fair premium in a competitive market. And so it's here, I guess the idea is this: like, you might think it's kind of weird that people are willing to pay so much for insurance, and a lot of the asset pricing literature will sort of retort and say, well, the reason that is because the insurance policy delivers you the payoff at exactly the moment that you really want a payoff. It's when you just crashed your car that the car insurance policy delivers you this payoff. right? So you're willing to pay something for that policy, because even though on average you're not getting anything, there's no like steady return you're getting. The problem is you insulate yourself from this bad event at exactly the moment when your marginal utility is very high, right?
Yeah.
So
So
at
like
that,
the insurance company will pay off at these times in the future where you need it, but you don't even know that you're going to need it at this day, this time yet. But the insurance company, the way the policy is structured, it will give it to you at these times of great catastrophe or whatever.
exactly.
Yeah.
And like you can sort of extrapolate that to say like, why do people like holding like safe assets? Because it's kind of weird. Like people actually seem to be sort of more risk averse than you might guess, based on, or than you might assume, based on based on like the prices people are willing to pay for like really safe bonds, and the prices that people and the returns that people demand for risky equity, stock securities. Like if you look at what people are willing to pay for these two assets, you might conclude, wow, people are really risk averse, because people seem to value this safe asset that gives them a very small return, but they seem to be willing to pay a lot for that return, because it's safe. So you could imagine, say there's this asset that pays you, $100 when a recession happens,
Mm-hmm.
and it's like this is like an insurance policy against a recession, right? And you can kind of right away, it's like, oh yeah, I'd be willing to pay a lot for that, because I don't know when the recession is going to happen, but it's when the recession's happening, whenever that is, that's when I really need money. That's when I'm likely to lose my job. That's when I'm likely to yeah, that's when the problem arises. The problems, arise.
So in this
So
framework, why buy the asset or buy the insurance policy, whatever it is, as opposed to just like hold a liquidity pile long term for the rainy day?
yeah, why do that? Yeah, actually, that seems like a good question, right? I mean, I guess it's probably costly to hold this liquidity pile, and you might think that there's gains to trade that might arise if I can use somebody else's liquidity pile when I need to. If I can instead of holding a liquidity pile, if I can just purchase a claim on somebody else's liquidity pile, contract with that person and say, when I need the liquidity pile, when this event occurs, or yeah, when some event occurs, then then I can use your liquidity, right? So I mean, it's the same, but I think also like this framework sort of allows for that too. Like it's not, there can definitely be situations where I wouldn't want to participate in some market given whatever the assets that are available on the market at the time, and I might just want to sort of stockpile cash, right? And cash is an asset. Cash is an asset with a certain return and a certain variability of value. So so that's like holding an asset. So so I feel like I'm on a tangent, right, to sort of like explain the like really general field that I see myself in. But the things that I try to focus on, right, are okay, well, in reality, we don't know what these probability distributions governing returns are. Like if you knew it, if you knew that, all these problems would be really straightforward. I mean, so if we knew what the probability distributions governing returns in the stock market were, then the stock market would be very much like a casino, right? You would there are a bunch of different gamble opportunities, and of course in the stock market, the nice thing is that a lot of these gamble opportunities are like they have like positive returns over time, and of course in a casino, they're all like negative gambles, right? You have to be very risk seeking to choose to play a game of blackjack, because on average, if you play blackjack forever, you're definitely going to lose. You'll lose all your money. That's just what will happen. Based on the rules of the game and the fact that there's 52 cards in the deck and whatnot. So the point being is that, like, if you want to think about the world of pure risk, right? And I'm going to distinguish risk from uncertainty or Knightian uncertainty. Risk is like being in a casino, right? The problem of risk in the casino is, what am I willing to play to what am I willing to pay in order to play a gamble that has a known set of outcomes, and I can assign known probabilities to each of these outcomes. And then the question of what am I willing to pay is just a question of how risk averse am I? So some people might be willing to pay a lot to play the gamble. Other people might be willing to pay very little to play blackjack. Other people would pay money to not play, right? But it's all just a question of, like, their preferences. That's just revealed preference happening there, right? So but you could imagine
the probabilities are fixed, mathematical, easy. Yeah,
they're known. I mean, like, flipping a coin, right? We don't know what the next coin flip will be. Like, it could be heads, it could be tails, right? But we know that it's a 50-50 chance of one or the other. And we know that, if you were to flip this coin forever, it would just converge to the total number of heads would equal the total number of tails, right? So in a world of known probability distributions, things are simple. And if you want to think about asset pricing, model asset pricing payoffs in that way, then the problem of what you're willing to pay for some asset it's just, again, it's like, well, that's just going to reveal something about a person's preferences for risk, But there is here's a slightly different problem, right? So say that like you're still in Las Vegas, there's still a bunch of casinos, but you're a little drunk and you don't know which casino you're in. You're walking around town, you don't know what part of town you're in, but you walk into some casino, right? And you could imagine this in Vegas. Let's say that there are 3 casinos. There's one casino where the only game is a 50-50 coin flip, right? And there's another casino where there's a coin flip, but it's a 40-60 coin flip, right? It's a 40% heads, 60% tails. It's a biased coin. And then there's the third casino where it's just reversed. It's a 60% heads and 40% tails coin flip deal there, right? So again, if you knew what casino you're in, then it's a straightforward problem. But if you don't know what casino you're in, then you face ambiguity, it's called, right? You face a certain kind of uncertainty. And one of the first people to write about this problem of ambiguity, where okay, let's say the problem is a little bit different because you don't know what the probability distribution is exactly. One of the first people to talk about that was Frank Knight, University of Chicago economist, who wrote this book, Risk, Uncertainty, and Profit, in the 1920s. And other people at the time who were writing about this include Keynes. Keynes wrote a book on probability, and Frank Ramsey is another name in there who did some other stuff on like Ramsey pricing, I think, is a concept in like public choice theory, I think. And there are a lot of other names. There was another Chicago school guy named Savage who posed the problem a little bit differently. What he said was, people use the idea of probability in order to make decisions, but of course nobody knows what a true probability distribution is, but everybody subjectively has their own subjective idea of the probability distribution governing whatever it is that they care about or are buying and selling, right?
And I guess the way that it's used in standard micro theory now is, even if it's not like people on the street are like doing these little calculations in their heads and they assign actual p-values to things, these are kind of extractable given preferences and given their other constraints and choices. What the p-value that they assign is extractable from their choice. So it's kind of like revealed knowledge instead of revealed preferences.
Yeah, that's exactly right. That's exactly right. Like all the same sort of as if logic, right? Of sort of a like a Milton Friedman's positive economics a kind of idea that are people say we don't face a probabilistic problem, it's a known problem, but are people really performing a maximization calculation as they make decisions? Of course mostly not all the time, right? But maybe they behave as if they do. And of course I think the three of us would agree that like there are some, there's some faulty limitations to that logic, right? That don't get at like, causal genetic explanations for human action. But
in the Rizzo sense.
Yeah, right. Yeah, in the sense that okay, well, like maybe that's a decent model that like describes like how people behave with an appeal to, they behave as if this is going on, but it doesn't really explain like what people are actually doing internally or socially or whatever. So so the idea that the explanation is like good enough because it's an as if explanation is yeah, Rizzo points out that that's limited. Other people do too, and I would agree with that. But the idea is that I think I think that a lot of, so my sense is that a lot of Austrian economists sort of bristle at probabilistic problems because it's like this additional architecture to a mathematical framework to talk about economic behavior. And it's like, well, in reality, no, I don't think people are walking around with these probability these probability numbers in their head. But I also don't think that people are really walking around with an ordinal preference ranking, of what they like better or not, right? But nonetheless, like Mises, uses this concept and says that it's like it's a pretty useful way to think about what you would infer from the observation of some choice, right? So so anyway, that's sort of a long.
I recently read Human Action. This is just a short point.
Yeah.
Recently read Human Action for the first time, actually, and it seems like
awesome.
If all of his stuff is about, it seems like if his whole point is that, okay, well, you don't need the constraint logic, you just need these ordinal preferences, and then when someone is presented with the means, they just assign it to like their ends in a certain order. It seems like all of the work, all of the choice theory in the whole thing is just by this preference ordering, right? So if Mises wants to, he can explain some strange event or some strange choice by, oh, well, it was higher on their preference ordering. That's always a theoretical choice, but that's the same kind of choice that we bristle against as economists, to just say people do what they feel like, and just that's the explanation of choice. People feel like doing something and then they do that. That's it. It ends up being actually quite similar, and we don't know how to deal with that. It's like Mises's version of choice theory is all preference based, almost entirely, basically.
Yeah, I think at points he sort of has like a choice based approach, but it's always like, well, you would observe choices and you would infer from those this ordinal preference ranking that and I think not unlike most like micro textbooks, there's this appeal to this kind of a duality between those two approaches. even in Mises, although I don't know if he uses those terms exactly, but
he's not going to say the duality theorem or anything like
no,
that.
he's not gonna. Yeah, he's not. Or like if he says duality, I don't think he's talking about mathematical symmetries and stuff. I don't. But he's like but yeah, exactly. It's basically just micro. I mean, a lot of human action. The book, right? And and like and I guess that's the point I'm trying to make about probability is like similarly to how like okay, are people walking around with this preference ordering? Maybe not, but you could, by observing choice, infer something about what their preference ranking might be, and they would likely have to sort of agree with that because at the end of the day you would sort of at the end of the day, I think what's undergirding a lot of that is basically like phenomenological reflection of like just like, well, hey, if you make this decision and you're choosing to forego this thing in order to obtain this other thing, then you must prefer this other thing to the going. And I mean the basis for that is to me, I have to appeal to like phenomenology to that's just sort of like internal reflection about like putting myself in somebody else's shoes. But my point about probability is that like no, I don't, similarly to preference ordering, I don't think people are walking around with probability numbers associated with all possible events. But when they make a choice to choose one asset over another and all other features of these assets are identical, then it makes sense it makes sense to me to infer that, well, they must perceive one of these assets to be somehow riskier than the other, and just in the same way that a preference ordering is a useful way to talk about, well, they must like this thing more than another. They must they must like this. Then they must, similarly to that, they must think that certain events are, more probable than the other. Anyway, that's a long digression. I guess the point is that like so Savage has this subjective probability approach, and but in the 60s there was he was an economist and a decision theorist, but he was also the guy who leaked the Pentagon Papers. Was this guy Ellsberg? I think it's Daniel Ellsberg. Interesting cat. He ran this experiment where actually it was more of like a thought experiment when he did it, but what he was trying to get at is that maybe people, in the same way that they are averse to risk, maybe they're averse to uncertainty about what risks really are, because they're uncertain about what the probability distributions governing some system is. Maybe they're also averse to that uncertainty, so they might prefer to go back to the casino example. They might prefer a bet in a casino where they know what the probability distributions are, versus a situation where they have to not only care about what those probability distributions are, but also they don't know which casino they're in. They don't know what the odds are on this coin.
So if I could think of an example, it would be something like a gambler in America going to another country where they don't know how the rules work. They don't know like anything about what the social interactions are. So things are far more ambiguous, even if in their native country they know to what degree things are I guess risky. They know the riskiness of things in their own country, but when they go to another country, they don't have the requisite knowledge to even generate how risky this or that is.
Yeah, I think like an international example is appropriate in some context. I think if you went to a casino in another country and they play this game that you're not familiar with, and it's like, well, in this game there's only 46 cards in the deck, and it's like you got to run the numbers like, all right, that's a 1 in 46 chance. Okay, that's different than a 1 in 52 chance that I'm normally getting in the in an American gamble or something. Yeah, right. I mean, if you're in a situation where you're uncertain what the probability distributions are, and like if part of that statement is about the cultural meaning that people at the blackjack table attach to to different actions and what people can and can't do. Okay, well, actually, if you've ever been to Vegas and you've been at a blackjack table, you'll know that there's this idea of playing by the book, and playing by the book playing by the book just means that you do the like probabilistically fair thing, meaning if you have a certain set of cards and there's a certain set of cards laid out on the table, then there basically the book, there's a literal book, but the idea is that you basically know what to do. You'll either hit or stay. You'll either try to draw another card or not draw another card. And there's a literal answer in the book for given the cards that you already have and what's on the table, should you hit or stay.
For every single situation or something like that. Yeah.
Yes, but people often don't play by the book, meaning if you've got a 20 and you get to 21, of course you want to get to 21 and you want to get over 21. But if you have two kings in your hand, you're not supposed to hit. You're not supposed to get another card, and other people at the table will be really pissed if you do, because there's this perception that, hey, that was my card. You're not supposed to take that card. That card was for me, and you played not by the rules, even though it's not really a rule. It's just sort of best practices, totally informed by the probability distributions governing the outcomes. So there is something like cultural and social happening at a blackjack table. It's not just like mechanistic, but I think the problem I'm talking about is it's sort of more technical than that. It's that if you don't know, I think the coin flip example is probably the simplest one, right? Like if it's a 50-50 coin flip, then and that, what you're willing to pay for that, then no problem. But if you don't know if it's a 50-50 coin, or it could be a biased 40-60 coin or a biased 60-40 coin, and you don't know what that distribution is, then you might act differently. You might act more cautiously. And this is what Ellsberg sort of noticed. Was he said, here is the example, right? There's an urn with balls in it, and they're black balls and white balls. And here's this urn, and it's 50-50. They say there's 100 balls. There's 50 black balls, 50 white balls. And then there's this other urn, and we don't know what the proportion is, right? And which do you choose? And so people tend to not want to go with the unknown urn. They tend to want to go with the known 50-50 urn. And this is kind of,
it could be like 100 black balls. It could be like a snake in there or something,
yeah, well, I think we can assume away the snake, but right, there could be it could be all white balls, right?
Yeah.
Or it could be all black balls, or it could be 75 and 25, or it could be, there could be any combination of proportions of balls in this thing. But there's something kind of perplexing about that, because if you think about all the possible like combinations of balls that could be in these urns, then you intuitively might kind of think, well, that should ultimately reduce to a 50-50 gamble, because yeah, it could be that there's only one white, and by the way, say that the gamble is like, pull a ball out of this urn, and if it's a black ball, then you get $1, right? Is the idea. So so it could be 99 black balls and 1 white ball, or it could be the opposite. But if you don't know anything else other than that you have this unknown urn and a 50-50 urn, it's actually kind of confusing that people would choose the known 50-50 urn, because yeah, it could be stacked against you with the unknown earn, but it also could be stacked in your favor. And actually like a priori, there's really no reason to think that it's one or the other. In fact, on average, like of all the possible combinations that could be in there, it might make a lot of sense to me to just treat it as a 50-50 earn, and that idea of taking multiple possible gambles and kind of reducing them down to one gamble is like a compound lottery kind of idea. And what Ellsberg saw was that no, people actually sort of exhibit this preference for known risks, and there's been a lot of experimental evidence to show that or whatever. And what people noticed is that, well, he's basically getting or reiterating this Knightian uncertainty idea, where where Knight talked about well, in the casino, determining what people will do is, it's just all a matter of kind of revealed preference. But in the real world, meaning in the economic realm, in the entrepreneurial realm, in the realm where the gamble is, I want to build a factory, and what is my expected return from this factory, or what are the possible outcomes that could occur if I offer this new untried product or service. The fact is that you have no idea what that probability distribution is. It's not even that it's hard to calculate. The problem is that it's actually just incalculable. That's the problem. And so Knight emphasized that, but Knight emphasized, okay, so long story short, since Ellsberg, there's been a lot of research in decision theory about decision making under ambiguity, right? And to sort of boil down the results, basically, yeah, people act a little more cautiously in situations of ambiguity, and the decisions that they make, basically they make them in order to they want to make their decisions robust to bad outcomes under probability distributions that are particularly unfavorable to them. So a really typical framework for this is called it's talked about in this paper from '89 called by Gilboa and Schmeidler. And what they do is they use this max-min preference model. Basically, what they say is this: if there are multiple possible probability distributions that could be the case, what a decision maker does is they make the decision as if the worst probability distribution for them were the relevant one. So what they want to do is they want to make a consumption or investment decision that will deliver them as high a possible payoff, given that the worst case probability distribution is the one that's happening. And there's some interesting stuff that happens because what that worst case distribution is actually depends on your choice. So there's an endogeneity there. So like just imagine if you what's the example I always bring up? Say that your portfolio looks like you're long the stock market. You've bought an equity index asset or something, right? Well, the worst case probability distribution for you is the one where it's very probable that the stock market tanks. That's the worst case distribution for you. But say that your portfolio is the opposite. Instead you're shorting the stock market. You've positioned your portfolio to benefit when the market tanks. Well, now the worst case distribution for you is just the opposite. The worst case distribution for you is that the market just keeps going up because you're shorting the market. So you're losing money as the market goes up. So that's what I mean by the worst case probability distribution actually depends on the choices you've made, which is that tends to get called an endogenous there's an endogeneity of the problem, and people do what's called uncertainty hedging to get around that. but that's to sort of like summarize it. There's a lot of other models to talk about decision making under ambiguity and stuff. But here's my basic sort of like critique. We've learned a lot from that literature, right? We've learned a lot about like, yeah, if people don't know this, then maybe they act more cautiously or differently. There's a lot of valuable stuff to get to that. Like and what the public policy implications are really interesting too, because if regulators or if people in general don't know what don't have a lot of knowledge about the probabilistic aspect of their choices and outcomes, then one result that you see is that what tends to be robust to that, a choice that tends to be robust and optimal in that situation, is one that is simple. Very simple rules, very simple institutions tend to do well in a lot of different probability distribution situations, right? So this idea of lack of knowledge leading to simple rules is actually something that you see a lot in the ambiguity literature. So we've learned a lot from the ambiguity literature. But the thing that I'm sort of critiquing slightly about it is that, yes, we've learned a lot, but there's something that Frank Knight originally brought up about uncertainty and why it's an interesting problem that goes fairly neglected in the literature. And it's this, is that for Knight, the interesting thing about it is not so much that we don't know and therefore reduce to some particular compound lottery and then make a deterministic decision. The problem for Knight was that, like, basically the idea of mechanistic decision in general breaks down completely when the probability distribution you're talking about is thoroughly like incalculable. So Knight's sort of angle on it is that the problem about unknown probability distributions is that the risks and outcomes associated with that situation are uninsurable. And what the ambiguity literature seems to imply is that, well, they're still insurable. It's just that you would have to increase the premium to sort of account for people's aversion to ambiguity. And Knight in a lot of passages seems to be saying that that's not the problem. The problem is that it's actually an uncomputable problem. Like that the problem is that he doesn't use those words. Those are words that I'm sort of grafting on to Knight. But he seems to say that no, the problem is that because you don't know what the distribution is, period, you cannot calculate an insurance premium, and you actually can't calculate what people would be willing to gamble with that, right? So therefore, it's not as though we have a situation where people are making decisions, like in a decision theoretical sense. It's that Knight frequently uses the term judgment instead of decision, and he kind of distinguishes those. As if to say, you really need, at the end of the day, you need a human being who's just willing to bear these uncertainties, and then sort of makes a decision. That doesn't really make a decision, makes a judgment to take an action, and that's a different like type of thing.
And that's the kind of thing that that when you're thinking about like things like the socialist calculation debate, it's not that kind of things that Mises and Hayek are saying is not something like, oh, well, a socialist planner can't choose. It's not like they're like stuck up there in the tower like, what do I do? Like, I don't know what to do. They do make judgments. They're like, we're going to do this. We're going to move all the bricks over here, and we're going to mine all the steel over there. So they do something, but they're doing it in this zone where they don't have the aid of calculation and the market and stuff like that. So choice at its like heart level is, as you're saying, some kind of judgment, which isn't uninformed. Like, you can make good judgments. We talk about people who have good character, but it's informed by something, but it's not information, like strictly speaking, risk, probability, stuff like that dictates how people choose in that kind of environment.
Yeah, exactly. Go ahead, Tegan. Are you? Yeah.
I was going to say that segues into my observation. I'm thinking about Alchin's classic paper on property rights here. where he argues that private property rights, private ownership in means of production will tend to cause those rights to decision-making rights over resources to be consolidated by people who have a comparative advantage in risk bearing, because those are the people who are willing to make decisions about the assets, and so they'll buy them and use them. And so the question is, if their comparative advantage is not coming from a capacity to better calculate the probabilities of outcomes, what is driving their judgment that gives them that comparative advantage?
Mm-hmm.
Yeah, right. It's almost like at the end of the day, you have to appeal to like, well, they're just willing to bear the uncertainty of the, like, if you yeah, no, exactly. I mean, like
is there better judgment, or is it just people that are more willing to make judgments? I guess that's one way of getting at the question.
Risks. Yeah.
I mean, it's like I think it's very possible to evaluate different judgments, but I think that the tools by which you would evaluate two judgments is very different than the tools that you would use to evaluate two decisions. Because in one case, there's a known optimal decision, so basically any decision that deviates from that is like wrong, right? But with judgment, it's like, well, ultimately my opinion about somebody else's judgment is ultimately going to be a judgment, so it's not there's an irreducibility of it that that I think is really interesting, and property rights may tend to flow to those people who basically are willing to just keep holding the property rights in bad times. Like if you're owning a piece of property, then you're basically the residual claimant of income that can be derived from the property, and I guess also maybe you decide how to use the property. But and in a situation where you know the risks, meaning in State of the World 1, I could get income X1 from owning this property and using it in this particular way. In State of the World 2, I could get some different outcome, and in some states of the world I lose money. In other states of the world I make money. If you are if you're the guy who's willing to bear that risk, then it would make sense that you would be the residual claimant, right? If somebody else is sort of better fit to or more willing to bear those risks, then they'll pay you some premium to be the residual claimant. So it's kind of a Coase theorem sort of logic for like resources will flow to the best bearer of risk.
But what another thing that I just thought about that we always talk about in econ is something like where okay, so we've got a firm, and there's a bunch of, it's publicly owned firm or something like that, and there's a management team running the firm, and they're doing pretty good. These are the people whose judgments we're concerned with. They're doing a pretty good job or whatever, but then this other management team thinks that they could do a way better job, and then they want to buy out the other management team, and this subsequently, based on the judgment of the world's, the judgment that the world has of this new management team's judgment being superior to the old team's judgment, the stock price will rise, is the idea, right? Because people will think that the firm will do better in the future. And I don't think that you can attribute that to risk. It's not like, oh, these guys are more willing to take risks, so they're willing to pay more for the same assets of the firm. We should value the firm higher or something like that. The increase in the stock price of the firm is not tracked through just like, oh, this different ownership or something like that, right?
Well, I think like a change in ownership probably signals some change in use of the productive resources of the firm, and like there are definitely situations where a merger or an acquisition will occur, and the market reacts badly to it, you
Mhm.
know, and they think, and they might think, well, you know, the parties that were a party to this deal, you know, they had their private incentives at play, and that's all fine. You know, it's not like anybody's saying that the parties to the deal, you know, acted not in their own self-interest. It's just that no share, you know, but ultimately they might privately benefit, but shareholders might lose out.
Mhm.
And you know, so you'll see negative market reactions to that. And but you know, like, yeah, where does risk enter into that? I think, you know, sometimes you know, you might see there's a certain profile of risks associated with some enterprise. You know, it does well in or poorly in, you know, recessions, and well or poorly in boom periods or whatever. You know, does well in a pandemic, doesn't do well in a pandemic, et cetera.
Mhm.
You know, and you know, so the shareholders who desire some exposure to those risks, and can be, you know, rewarded for bearing those risks, you know, they'll probably buy and sell until they're the holders of the risks that they're willing to bear, right? But like, the you know, you might have a situation where, like, you're a shareholder and you have a certain preference for risk, and the management of a company that you own has a different preference for risk, you know, and they're acting maybe like too cautiously or too risky, you know, but maybe they're taking on, you know, you know, like, you know, they're not offering enough, you know, new products and services. You know, they're not investing enough in R&D, in totally uncertain ventures that may or may not pay off. But I like that risk, so, you know, I want the management to be changed, you know,
Mhm.
in order to. So I mean, I think yeah, incentive alignment, you know, between investors and management. And but I guess at the end of the day, because you ultimately can't calculate, because these risks are unknown, we have to appeal to something like raw human judgment in
Mhm.
terms of like what's driving these decisions, because because, you know, there's probably no mechanistic answer to
Yeah.
it. So I guess
The
I
the
want to,
term
like,
that
yeah,
the
go ahead.
term that I've generated in my head for what you just said, mechanistic answer, is something like, it's not a logical answer, so it doesn't pull out from the logic of the situation, but it's also not arbitrary, right? So an example would be something like, if you read the work of Thomas Schelling on how we generate focal points with each other, right? So
Hmm.
something like, if I said, if I was setting up a game between you two, and I said, like, okay, well, each of you pick a number between 1 and 100, and then if that number adds up to more than 100. Well, no, you know what? That's not a really good. That can be done with normal game theory, so that's not a really good example. But the best
Already I would
example that,
choose
yeah,
50.
yeah, I know. So the point is that you choose 50, but I think that you can actually generate that answer from just like
Because
maximizing
it's
game
right
theory.
and just
Yeah,
to
I
choose
know.
50.
Yeah, that's like the focal, like those ideas about what you expect other people to play to are also related to something like justice. But the idea is, okay, one of his best examples is, you're both paratroopers, right? And you're flying above, you know that you need to meet up with another paratrooper on the ground, and he's in a different plane. And you know that he also has the same map as you, right? And so the map has like a bunch of trees on it, different clusters of forest. It's got a village or two here. Some is in the woods, some are not. Um, it's got a road running north to south, and then it's got a river running west to east, and it's got a bridge where the road crosses the river. And then they've also got like a church in one of the towns, and then there's a small like monastery as well. This is in like France, I guess, right? So then the question is, okay, and if you don't meet up with your partner, you die, because you can't fight alone. But if you're both together, you can take out a whole squad of Nazis or whatever, right? So then the question is, where do you meet?
Yeah, and it's like the bridge. And I
Bridge.
don't know
Bridge,
why.
yeah, the answer's the bridge. Yeah.
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 And I don't know why. It's also like I was thinking, as you said, like there's a church over here, there's a
Yeah.
monastery here. I was thinking like, oh, like yeah, like tell me there's a synagogue over here also and a mosque here, and it's
Yeah.
like and then it's like, well, I'm not gonna go to any of those because I don't know what religion this guy is. Maybe if I knew that he was, but it's like, yeah, I would just go to the bridge.
Yeah. But
And
that
that's a
answer's
Schelling
not
point.
logical. It's not logical. It's not like of all the so the closest that Schelling gets to like a generalized conception of how you would choose a Schelling point is uniqueness, right? If there's some kind of like if we were to say we're going to meet at a building in the city, the tallest building, I guess, right? Or something like that. So it's actually quite a fun game to just test like Schelling points between people. Like if like the universal, I'm going to meet you and I'm not going to tell you where, I'm not going to tell you when. Schelling point is Grand Central Station in New York at noon or something like that.
Right.
That's like the closest universal one you can think of. But that's for people in America. For people in Tokyo, it's whatever, right? It's somewhere in Tokyo. Big Ben for people in London or whatever. But
there's an interesting related point Michael Polanyi makes in his discussion of language. He has this brief excursion on philosophy of language that kind of keeps recurring. The same kind of excursion recurs throughout his work. But the way he puts it is that anytime we use a word, we both affirm the meaning that it has currently and change its meaning by putting it in a new context. And so there's some irreducible act of personal judgment involved in the use of a word. You're not a input-output machine that can that's taking inputs from the world and then spitting out things that directly symbolize them in like a one-to-one correspondence or something like that. Because even if that's what you were trying to do, that wouldn't work if you're trying to communicate to someone who hasn't seen the world exactly the same way that you have seen it. Instead, you're trying to like reach this shared state of vision about the world, having initially started at different positions of vision. And the way to do that is to use words that you both know, but also apply them in new ways that are like fundamentally changing what you both know. And that's why that's how you can like achieve greater knowledge about reality through language.
Yeah,
and Gadamer and Charles Taylor both make similar points, actually.
Sometimes those new situations are pretty familiar, like, oh yeah, obviously we would use this word in this situation. But sometimes it's like, oh, is this a case of X? And then you both are like, yeah, this is a case of X or whatever. So, and then the language grows that way.
Yeah, exactly. Like your use of the word, Marcus, use of the word awkwardness to describe these things in institutions. It's like no one would think of that word, right? But then like when you use it and it's like, okay, yeah, that's exactly the right word to describe the ideas that we're trying to get at in this conversation.
And now the meaning or definition of the term awkward, slightly changes.
Yeah, exactly.
Because it's like, oh, well, part of what makes that definition is the possible ways in which it could be used. And it's all about are we defining this word? And these the like topics of philosophy of language, it's very like, you can see how these ideas about game theory and economic coordination are related to to judgments and decisions made about other kinds of complex systems like language, or like so the friendly debate between Russell and Wittgenstein is very relevant too. Like, can we think about words purely based on a synthetic a priori definition of the word, and then deduce everything about the words from those first principle definitions? Or is it more like Wittgenstein sort of paints the picture of like, well, really the meaning is actually sort of something that falls out of how the word is used, and we can offer a definition for some word or idea, but ultimately that definition is going to be sort of incomplete. Like that definition will be that definition probably won't capture every way in which people use those words. Just in the same way that if you open up the dictionary and turn to the word awkward, you would see some description. You wouldn't see an exact description in the way Marcus used it, and yet, right as you hear it, it's intuitively appealing to be like, oh, sure, like that also is awkward. Yes, yes, I affirm that, and thereby, we've like mutually changed the definition in using the definition, and so like this sort of like and that so I'd like to sort of call that idea like reflexivity, right? And that's not a word I've made up. There's actually like this idea that by engaging with the system, you change the system as a participant. This idea is something that George Soros actually writes a lot about in financial markets. He says, if you wanted to, if you're trading assets within a market, one way to think about that is that you're a guy with an opinion, about what the market is now and sort of where it's going or what it should look like, right? And you're trading accordingly based on these expectations for the future and your opinion of the now, and also you're sort of incorporating what everybody else's expectations may or may not be, right? There's a Keynesian beauty contest kind of element to the to the decision of the judgment, and what Soros says, he says a lot of other things about economic sciences in general that like I don't, it does not appeal to me, but what he gets at that I think is like really insightful is that if you have some proposition and about what the market is or is like, or some fact about the market, and the way in which you want to run an experiment to test that is you want to trade an asset, and by doing that you're affecting the economy. You're not like traders in markets are not passive price takers, right? But the passive price taker idea has traditionally been very useful to economists, because you can think about how people adjust their decisions in like partial equilibrium to given a given price, I adjust my decisions accordingly, right? But when my decision adjustment affects the price, then we have sort of a more complex situation. And I think Soros kind of talks about that reflexivity very, very eloquently. And and I just kind of think it's a shame that he doesn't sort of fully tie it back to like Adam Smith, because the way that Adam Smith talks about like the way that individuals form moral judgments about the right and the wrong and the good and the beautiful and the and the ugly and the bad is similarly a complex reflexive kind of process.
And Adam Smith makes a distinction between the judgments that are precise and accurate, the things that are easy, that like in common environments that you can always we always know what the judgment's going to be on the situation pretty much. And then that's which is loose, vague, and indeterminate, which is like judgments about, oh, did you phrase that properly? Did they do this? So he makes an analogy to the rules of grammar, which are precise and accurate. I'm pretty sure I know when you broke a rule of grammar or not, even though sometimes that's a bit sketchy as well. And though that which is loose, vague, and indeterminate, like, did you write a good essay? That's an example that Dr. Klein uses to talk about it. And so, and I think that Abby Devereaux, I haven't fully read the paper, but she's written a paper basically on how that kind of every authentic moral theory that like people are actually going to be using to help guide their judgments is going to have a precise and accurate element to like actually to make it be something, right? To make it not just be like a collection of judgments in particular situations, but to have it actually be like its own perspective on things, have some common principles where you try to apply these to as many situations as possible. But by the nature of the way that if you have a finite set of rules and an infinite set of situations, you're always going to have this extra dimension of looseness, vagueness, and indeterminacy or something like that. That you're gonna reach someday. You're gonna get there someday if you keep filtering through new situations or something like that, right? So yeah, and so we've shifted the conversation to talking about like incompleteness and stuff like that. So
maybe I can just wrap up a couple of things about the uncertainty stuff real quick.
Sure.
Just to sort of like, smooth, like, cover the transition is like, so Knight talks about uncertainty as being a problem that requires human judgment. Soros talks about the reflexivity of traders in the stock market. And also, I would want to bring into the conversation like Ludwig Lachmann and maybe Peter Lewin, also Austrian economists who I think one way to characterize their work is that a greater emphasis on the subjectivity and uncertainties that real investors and agents within an economy actually face, and also the fact that it's a complex system with reflexive properties generates a situation where it may or may not be meaningful to think of an equilibrium concept for a whole economy or for a whole market within a broader economy. That when we situate properly ideas about like what should and shouldn't be done with resources, and recognize that those ultimately boil down to subjective opinions of different agents, and there's different answers to these questions of how to most effectively use resources. And there's not just one answer, and it's not just like there's like an array of possible answers. It's that maybe the question actually might not have an answer, and that what might make more sense is to analyze that's how I perceive their work. This and there's Shackle also has kind of these collidic kinds of concepts of equilibrium that are worth bringing up.
And Richard Wagner at GMU, of course.
Yeah, Richard Wagner. I mean, yeah, right. I mean, like, yeah, we could go on. I mean, because there's a lot of this. We could bring Nietzsche in there too. I'm all for that.
Classic.
Yeah. But I guess what I'm trying to do is take the technical tools of theoretical asset pricing and incorporate this ambiguity and uncertainty, but also bring in reflexivity by saying that well, when agents within a market are taking actions and their actions are affecting prices, the reflexivity of that process generates an open-ended dynamic indeterminacy where to the point where if you were to ask somebody, is this market in or out of equilibrium, they ultimately they face a real epistemological constraint in that you're actually unable to answer that question. It's not that I'm saying the market is always inefficient and out of equilibrium or efficient and in equilibrium. It's that no, actually, for those concepts to be meaningful, they have to be individualized, and therefore, therefore asking that question is probably not a decidable question. And the way I do that is I basically try to bring in some tools from quantum physics to model asset pricing. And the analogy is basically this, right? Think about a particle, and sort of the beginnings of quantum physics. A way to kind of wrap one's head around quantum physics is to just think about a small space with a particle moving around in the space, and you want to ask questions and describe the motion of this particle. And the problem is that you face a kind of like measurement uncertainty at a certain limit. So if you try to measure the position of this particle, say you want to ask that question, you're looking at this particle move around, you want to say at time t, where is the particle? And you would think that you can answer that question, but the problem is that like when things are quite small, it's difficult to measure them. And when you try to take this measurement, your process of experimentation and measurement actually changes the system that you're measuring. So with the particle example, the thing is that like you have to basically shine a light onto a location to see if the particle is there or not. But in this realm, shining that light will actually shoot photons at the particle. So you'll actually move the particle by measuring the particle, right? And this is a problem. This is a problem because as you become more accurate in your measurement of where the particle is, you effectively have to like shine further light on it. And by the way, like it's, you know, the uncertainty principle, it's not about photons, it's not about light, it's not about the particulars of any particular experimental context. This is just the example that sort of allows a person to kind of like, you know, wrap your head around it initially. Like, so in this example, it's photons from a you know, an electron, you know, microscope or something like that. Like, but it translates to a lot of different situations, right? So but in this, the problem is that by trying to find the location of the particle, you move the particle. And so that's why there's this trade-off in the uncertainty principle. So the uncertainty principle states that the more you know about a particle's, the Heisenberg uncertainty principle states that the more you know about a particle's location, the less you can know about its momentum, its direction and speed of movement. And the idea is quite intuitive, actually. It's that by finding out where it is, remember, you have to shoot photons, that you actually have to move the damn thing, you know? And by moving the thing, you've changed its momentum, you know? And therefore the more you can measure its location, the less well you know about its momentum, because you've effectively changed the momentum. And the analogy to trading in a stock market, right? Here, the unit we're analyzing is not so much, it's not a particle. What we're thinking about now is equilibrium price of some asset, right? And if this asset's moving through time, you know, we want to talk about its position and where it's going and describe it, you know. And basically I'm using those sort of tools and framework to talk about how, well, in a financial market, the key question that people always want to ask is this market efficient, right? And that gets phrased in terms of a hypothesis that has been sort of brought up at least 100 years ago, but has probably been stated most succinctly by Eugene Fama. And the idea is that markets are efficient if they incorporate all available information. If all available information is reflected into the price of an asset, then it's informationally efficient. You know, and you know, the idea being is that, well, if I have some information that nobody else has, right, and that information leads me to think that some asset is overvalued or undervalued, you know, then by trading, I effectively bring that information to the market, you know, and people don't need to know why the price is being bid up, you know, necessarily to understand that somebody thinks that they have some information that's relevant to the price of this asset and they're trading on that information. You know, a market is thought of as efficient if if basically people are able to do that, and at any given time, all the publicly available information is reflected in that people can come and trade on it, right? So so it would be right. So we want to ask a question like, is this market efficient or not? Well, that's the question that traders in a market are always asking themselves as they trade. The hypothesis, the null hypothesis of a person trading in a financial market is that the market is inefficient, right? They think basically there's this information out there, but it's not being fully incorporated into the price. Therefore, I will buy or sell and benefit from that, right? I think the market is inefficient, and then I'm going to make it more efficient, and then you'll see that I was right, or you'll see that I was wrong, right? But the trade is a test.
And when
of
they're
that
wrong,
hypothesis.
it's not necessarily that they're wrong that the market was inefficient, but that they were wrong in the way that it was inefficient, perhaps.
Yeah, they could be well. Yeah, they could be wrong in that way, or the market could have been efficient the whole time, and they were wrong that the market was inefficient. I mean, if it could be any combination of things. I mean, they might have made the correct like directional prediction in that maybe they bought the asset and then the price of the asset moved up and they made money, and it's like, yeah, maybe the market was inefficient and now it's more efficient, but maybe they thought that the price would go way up from there, and they were wrong by that difference or something. There's tons of combinations of things that could happen, but or they could be wrong about what asset classes, how different asset classes respond to different events, right? Like somebody before the pandemic might have said, well, I think this market is inefficient because it's not properly, people are not pricing in the risk of a pandemic. There's this possibility that nobody works for several weeks or months or maybe even years, and nobody's really pricing that in. Prices are way too high. They should be a lot lower because people should demand a high return because the risks out there are big. And but they might be right about that, but they could be wrong because they might have said this. That's the case, and the sector that will benefit from that will be utilities. Because everybody will be at home, so they'll be using more electricity. So utilities will be the sector that benefits. So the way in which I would exploit an arbitrage opportunity based on this inefficiency is I would buy utilities, right? And that would be their strategy. That's their hypothesis. Basically, they're saying utilities are underpriced, and that's the story they're telling about why. Yeah. But then they could end up being wrong about that, because really the companies that benefited big were like pharmaceutical companies, and then at the other end of it, they'll be like, pharmaceutical companies that were underpriced, and they didn't know. So it's very complicated. But I guess the point I'm making is like, you have this opinion about whether the market is correctly pricing assets or not, and when you make a trade, you affect the system. And this is a long explanation, so I apologize. But that reflexivity is basically what I'm getting at. So the way that I phrase part of the uncertainty principle is, the more you know about equilibrium prices today, the less you can know about equilibrium price momentum, about where it will go. And there's some other ways to there are some other uncertainty principles that fall out of that, but that's the key. That's the key. But okay, I have totally failed at making this a smooth transition. Utterly failed. Instead, that
was awesome anyway.
Yeah. I see. I think I'm seeing how all of the other stuff comes together too. And so if I can add something, there's another area that you can put incompleteness in that I think might be related to all this. that we were studying at the beginning of this semester. I'm in a class on economics of institutions with Dr. John Nye. And so one thing that he was talking about was we're asking the coast question, right? Do I buy things on the market? If I want to produce something, do I buy the inputs on the market, or do I make them in-house, right? And this is like where Coast generates the idea of transaction costs. This is like the genesis of that transaction cost revolution in economics or something like that, right? But so one of the ways that you asked, one of the reasons that you might make something in-house rather than buy it, not really focusing on Coast's stuff anymore, is do I think that if I'm going to purchase something from you, I can actually specify all the terms of our contract, right? So if I'm a firm that needs to use coal to produce something in my plant, and you're a coal mine or something like that, I can say, I'm going to buy this amount of coal from you at this price, but I might not know what specific type of coal. I don't know like the quality that I need, all this stuff. This isn't stuff that I can specify beforehand, but it's stuff that when later I figure out that I need a specific thing, you would renegotiate the contract in your favor, right?
And you could get a holdout problem.
Yes.
Because of that. Yeah.
That's that's the Oliver Williamson.
Yes. So generally the idea is that in that situation, you would prefer to purchase the coal mine yourself so that you can avoid that problem entirely, right? And that's literally, it's called contract incompleteness, right?
Yes.
So
this is so like this is very analogous, right? Because like yeah, totally. No, I'm like Hart and Moore are other names associated with this literature in addition to Williamson, and or Williams or Williamson. I actually forget. Williamson. Yeah. So right, and like it's a different idea from this idea that like it's costly to use the market in order to obtain some resource that I could produce in house, right? It's like like there's this additional contracting cost, which is just the cost of like I can't predict all future outcomes. I cannot write a contract that delineates what two parties to the contract will do in every possible state of the world, or every possible contingency. Yeah. And like I think too, though, one minor wrinkle to that, right, is that like I don't think that Williamson and Hart and Moore and all the others in that literature, I think like they point out some really interesting things, like especially that like property rights are a way around that, because if you just have a person who's a residual claimant and they own the property, then basically the contract looks just like totally uniform in that it's in that like what they do or don't do with the property is no longer like listed in a contract written in a finite discrete like language with a countable number of characters. It's no longer done that. It's actually just delegated to human judgment and discretion.
Yeah.
And yeah, go ahead.
This is something that I've noticed about the term transaction costs. We use it all the time as if this like solves inefficiency or questions of like, are people acting inefficiently or not? And you go, oh, well, there's transaction costs, that's why they don't do it, right? But that's not really what transaction costs are or how they work. And I think that like
they're not like
taxes.
They're not like
taxes.
Exactly. You know,
Exactly. It's not like okay, in the Coast situation when he goes, okay, there's a cost to using the market. I kind of know what that means. Like it's like harder to like I need to go negotiate with someone instead of saying like you do this or something like that when they're already my employee, right? And so maybe like every widget that I have made in house costs like less, like $1 less. If we just say if we're able somehow conceptually to put a price on it, it costs like $1 less, then it's fine. Like it's efficient. They totally maximized it. But the actual cost, what is a cost? Oh, well, there's an opportunity cost to like writing up the contract or something like that. But the real difficulty, like there's still variation there in what the cost is, because it's also like it's also a question of like, am I able to like do it properly? How do I have that skill? What is that skill? All of that stuff, the on the market activity, when it's two firms like rubbing up against each other, like it's a question of judgment again. And so so I think what I'm trying to say is that it might be that we improperly defined this thing that Coase is talking about as a form of cost. Well, he says that too.
Transactions cost. Yeah.
Yeah, all the transaction costs discussions may have been improperly like conceptualized as a form of cost.
Yeah.
Rather, they should be conceptualized as the question itself. How do you actually like it? So it's a puzzle. The transaction itself is the puzzle, and Williamson does kind of get into that, and because he relies on Hayek and Buchanan in an essay that he has in 2012, and he says like, yeah, so economics is not a science of allocation, it's a science of exchange, like what happens in certain exchange contexts and environments. So like something that Dr. Nye brought up was like, never in mathematical models where they're trying to talk about transaction costs do they give a number called the transaction cost, right? So I think it's it's not Bankton Holmstrom. It's no, well, that's the guy's name, Bengt Holmstrom. But that
Holmstrom, Holmstrom's totally another name in that.
Yeah, it's Hart and something. I'll look for the paper. Yeah, the Hart and Moore paper. They're modeling this contract incompleteness question, but they don't put the way that they put contract incompleteness into the model is they build a game where you have a choice in the first period, and then in the second periods you have new information because the contract was incomplete. So the transaction cost is built into the structure of the game. It's not one of the costs within the game itself. So the entire game is the transaction puzzle that leads to a unique kind of dynamic outcome. But it's not like, oh, well, I accounted for transaction costs, so I'm still maximizing. It's different. It is different. And people like jump that because they can just say it's a cost, but we're done.
You get something like that conclusion in Alchin's paper in the 90s, where he tries to summarize the transaction cost literature. I think the paper's just called "What Are Transaction Costs?" And he comes down on the definition: they're the costs of defining and enforcing private property rights. But then when you think about that, what's the cost of like defining something? Enforcement, maybe you can put like a dollar value on that in certain cases, but defining, like, that's just like, what are you even talking about there? And that, so I think the definition is absolutely right in encapsulating what had gone on in the private property rights transaction cost kind of literature up until that point. And I think it also opens up a lot more questions than it solves. Because when we look at that, the whole debate has to change. The discussion has to evolve to look at what it means to define something and how that can be costly, and what the costs, if that even is the right word, are for defining a thing.
And there's a lot of different directions to take this, because like one problem of contracting that I think relates to all this is like, well, say that there's a cost to calculating what the transaction costs are. Well, then there's a cost to calculating what the cost of the calculating
regressive costs.
So there's that, right? So there's this there's that iterative recursive kind of that already creates like a real problem, but also kind of keeps things within a like cost framework, but then, like you guys are saying, like there's also just qualitatively completely different texture to this problem if it's stated in a different way. Like it's not just like a transaction costs are like a lot of different things. Like it's not just like a here's an example that I heard in a class once, and I sort of bristled at it, right? The professor said that lawyers' fees, these are a transaction cost. If you go to if you have a dispute and you want to resolve the dispute, well, there's a transaction cost there, because you're going to end up having to pay lawyers, and that's a cost. And it's like, well, that's a cost, yes, I agree that much. but like, aren't these lawyers also reducing transaction cost? Like, otherwise, why are they getting paid? Because so, I remember sort of bringing this up, and it was just like, yeah, actually, I don't know what a transaction cost is, because
Yeah.
it's like, are they, we'll often say, like, or like Mike Munger will say this, that like, like what do basically, like, how do corporations make money? Like, they reduce transaction costs, but in doing that, they incur transaction costs. And it sort of all suggests, it's like, well, maybe the cost paradigm of thinking about this decision to use a market or not use a market, or use a certain kind of institution or a different kind of institution for allocating a resource, maybe the cost paradigm in comparing these different alternatives is a little limited, which is kind of scary to think about as an economist, if we're going to move away from cost. It's like, cost is a very useful way to think about decisions. It's just, decision making under constraints. I mean, that's a very, if I could very tractable. If I could somehow squeeze this problem into a constraint proposition, then that would make my life easier, right?
Yeah. So okay, so another example is a high-low game in game theory, right? Where both of us can play left or right, and then if we both play left, we get a payoff of 5. If we both play right, we get a payoff of 3. Otherwise, we get a payoff of 0, right? So
Totally.
if we're both at the 3-3 equilibrium, you say, okay, so why don't people switch to the 5-5 equilibrium? And I understand that, like, formally, like in a Nash sense, like, the model's designed so that they don't do that. When they're there, that is formally a Nash equilibrium. I'm not denying that. So
the payoffs are such that the socially optimal outcome is different from the privately optimal outcome that they coordinate on.
The socially optimal outcome here is privately optimal, just you have to be there, right? It's not the same thing as a prisoner's dilemma game.
Oh, okay. So this is not okay. Yeah, so it's not that they have an incentive to defect from the optimal. Okay.
This is just, we both need to play the same thing, but it's better if we both play one over the other, right? Or something like that. So
both play the same.
It's called sometimes it's called the coordination game, or it's like the road game. It's like we both need to drive on the same side of the road, like egocentrically as everyone else, or else we crash into each other. But it would be better if we all drove on the right side, because all our cars are designed to drive on the right side, right? But if we all drove on the left, it would be like, okay, right? It would be better than nothing. So if we're all driving on the left, what we all realize, so someone goes, okay, why don't we switch to the other side? Oh, well, because of transaction costs. Oh, like that's like, that can be given as an answer, but that doesn't actually mean that somebody needs to, what puts someone in a position such that the transaction costs are so high that you can't switch. It has to do something about the way that you communicate with other people. And like Tegan was bringing up with language, every single time you use language is a new opportunity to use language in a different way. So the real question is, how do people generate the ideas to know how to communicate with all the other drivers so that they can switch sides of the road to be on the better side, right? That's the real question. And that's not something like a cost, that's like a failure to come up with a solution. That's not that's and then you can say, oh, well, they failed because the costs of thinking are too much or something. But
or the benefits of changing sides of the road are literally zero, because you could be on either side and not make a difference. But like in other situations where it's not, I mean, how do people it's kind of mind-boggling. And if the explanation just appeals to cost, then it's like, it seems to be missing something.
Yeah, it does. And so the real question is to identify the puzzle properly, and then how does someone solve the puzzle?
There's also like, okay, so I think this is an important thing to bring in too, is that like, I guess I'll call them efficient inefficiencies. Is like, you might think that, so I'll just put this the way that I'll put this in the context of like of my work with like, you know, in you know, asset pricing, right, is like if you have if what we try to do, or if our definition of efficiency in a market is about informational efficiency and people bringing information to the market and trading on that information until the prices in the market reflect everybody's perception of what the information is and what it means. If so, say that the so there's a paper by Grossman and Stiglitz, Joe Stiglitz, from 1980, and it's really interesting.
This is the credit rationing stuff.
It's not the credit. No, it's not the credit rationing stuff. It's I forget the name of the paper, but it's Grossman and Stiglitz, 1980. In it they ask, like, so are markets efficient, right? And what they say is like, well, obviously they're not efficient, because if they were efficient, then you wouldn't see anybody trading. If all the market, if markets already incorporated all this information, then there'd be no more information to bring to the table. There'd be nothing to do. But obviously you don't see that. You see people trading all the time. And they don't even emphasize the trading. What they emphasize is that like is that but that is one element of it. And it's sort of this thing that's looked at as a mystery in a lot of academic finance, is like, why is there so much trading? Like, you know, how could that be? And what Stiglitz and what Grossman and Stiglitz highlight is that, like, you need to preserve an incentive for people to, like, so we're talking about a resource allocation mechanism, you know, called a stock market, you know, and if that allocation mechanism is going to work tolerably well, then you need to preserve some kind of like the system needs to reward people who bring information to the market. So there needs to be a profit. There needs to be really, I think in their terms, it's more appropriate to call it a rent. There needs to be some rent that can be earned by a person who's bringing their information to the market. And so that's what they say, is that it's actually efficient for a market to be slightly inefficient, so that you preserve this layer of like arbitrages that could be exploited by people who have information to use to exploit those arbitrages.
Isn't that essentially what Kerzner says, though?
Yeah. This is why I'm like, Stiglitz, are you serious? Like, Stiglitz is a lot of his work is really phenomenal that way. Even though
Demsetz makes a related point in his 1964 Exchange and Enforcement of Property Rights.
Totally.
Totally. Yeah, I mean, he's got a bunch of examples in there. My favorite one is the mall parking lot, where you imagine a super mall parking lot, and it's a tragedy of the commons, right? Because all these different people are parking in it who aren't paying for their parking, and they're not buying anything at the mall, so they're not subsidizing the parking lot through that. So you have a bunch of like window shoppers and misbehaving teenagers and whatever else come and use the parking lot for whatever purposes they have. And so, well, obviously, as an inefficiency, you've got to allocate this. You could fix it if you just allocated parking by the price mechanism. So start pricing parking, reduce the number of spaces you have, ration it according to willingness to pay, and then the inefficiency is taken care of. And what Demsetz points out is that obviously that's not the solution, because there are, and the way he puts it is, there are costs associated with pricing parking, all sorts of things. And so that's where he picks up on the transaction cost thing. And I think it's really interesting, because in that case, I think the word costs really does work.
Yeah, right.
So,
but he's also talking about something. Go ahead. Yeah.
So he's talking, the principle he's getting at is still the same thing as like what we've been talking about earlier in the conversation. So what I'm really curious about is, like, why does it seem like the word costs works there, but not for other instances of these transaction costs we've been identifying?
I think, and I'm not married to this idea, but like, I think it comes down to calculability. Like, I think it comes down to the fact that, like, some costs, they're known costs. You know, like the problem of facing a known transaction cost is one kind of problem. And in such a situation, you could imagine entrepreneurs rushing in to collect a rent in order to reduce that transaction cost. But when the transaction cost is unknowable and incalculable, then it's hard. It's a lot harder to say what people will or won't do in that situation. But it's still a situation where there's this cost that is clearly incentivizing action. I mean, like, whoever is bearing some constraint, or however this constraint is being shared, it's still a constraint. It's not like people are going to like not react to it, So is it a calculable constraint? Well, then you can you can draw a budget line and talk about what people will or won't do, or what their optimal, or look at their action and say, well, that means since we know the budget constraint, and we know everything, we can infer something about the preferences. But when it's an incalculable constraint, then it's still going to influence action. But anyway, I'm thinking, I'm sort of thinking out loud. It's just
that's what's super cool about strategic thinking, is that the other, in game theory, like what the other player plays. I mean, your strategy set is your formal constraint, but what the other player plays is also kind of a constraint. So your question of, can you calculate what the other person will do? In formal game theory with math, you can. They have a utility function, you calculate it. But I mean, when you have to assign like a probability to what they're going to do, how do you really calculate that? And it has to do with being able to interpret and judge in the moment what the character of this other person is, what their desires are, all kinds of stuff.
And like the type of information that you're using to like inform those opinions, like it could be of a kind that's amenable to a deterministic quantity of what this cost will be, that I'll then sort of insert into my calculus, or like there's all these constraints and prices that I know, but then there's this other price and constraint that the problem is not that like I'm kind of unsure about what it is. The problem is actually that like it's impossible to assign a number to that thing, which by the way, I think mathematical economists will hear that sometimes and say like, well, that's just hand wavy nonsense. That's just like, oh, math can't solve it. And it's like, well, that's just giving up on the problem. It's like, no. it's actually an advance on the problem, because I'm not just saying like, oh, it's hard to do. It's an impossibility theorem. Like,
there's a reason why in principle you can't do it.
Yeah, it's a
and
proof
you've identified that reason.
It's a proof that you could not prove.
Yeah.
Or it's a proof that you could not quantify. So Grossman and Stiglitz talk about this in financial markets, and what they say is that like so I guess the thing that, let me just connect this back to the uncertainty stuff, so what Knight initially talked about, the problem with ambiguity and uncertainty being this incalculability problem, that, and it's this inability to calculate a rent, inability to calculate a probability, takes us from like, well, okay, so entrepreneurs could earn some known rent from bearing this known risk, takes us into a realm where actually the downside, we have no idea where it is. The upside, we have no idea where it is. It's a totally unknown thing. So the reward or loss that somebody would take on by bearing such an uncertainty, we're going to call that profit as opposed to rent, because of, so for Knight, that distinction between rent and profit is really the interesting thing about any distinction between risk and uncertainty. He always ties it back to like, and what is that going to mean for entrepreneurs in the economy. And in a but I think that like one element of that, right, is like, moral hazard is a commonly sort of like cited like market imperfection that prevents prevents an efficient allocation of resources. I don't know quite how to put it, but
prevents some exchanges that would be beneficial from happening or something.
Yeah, thank you. So one way to think about that is that when you have a situation of moral hazard, so just think of like an insured and an insurance company. If moral hazard is present, then basically the insured person can take actions now that they are insured, which will change the probability of the insured event occurring, right? So this means like unemployment insurance, like a big problem with unemployment insurance is if I was insured for being unemployed, like if I got unemployed and then I from my insurance company got a check, a big problem with that, or a problem with pricing such an insurance policy, is that once I'm insured, I could then quit my job, and collect the check, and this would prevent, my ability to impact the probability of the event is a way to think about moral hazard. And and what does it do? The effect is basically the same. My impact on that imposes a kind of indeterminate cost on everybody, because the insurance company now doesn't really know how to price such a policy, right? In fact, it seems like any price they charge could, I could do something to make that unadvantageous for them, so pricing insurance policies in the face of moral hazard is difficult, maybe impossible. And the problem is, again, this like reflexivity problem of like, I'm gonna, I can take actions that will change the probabilities of the outcomes that I'm then sort of like responding and acting in the face of as constraints. I'm changing the constraint that I face by acting. And so that generates, so I guess sort of my theory is like that reflexivity in financial markets generates this sort of like layer of efficient inefficiencies, this like layer of arbitrages that are available and present but go unexploited, because their presence actually can't be like deterministically proved or identified. So like
maybe a better term would be beneficial inefficiencies,
because
because saying that they're efficient inefficiencies implies that whoever is like allowing them to happen has pre-understood all of what you need to establish this is where it's going to be, this is where we need to put these inefficiencies or something like that, which is not exactly the case. It's just recognizing that they're part of what makes the engine run, right? But we're and we can know that like, hey, we're pretty good right here, or maybe this would be better, but we never know if we're there yet.
Yeah, that's right. It's that limiting inability to know whether we're there yet. That is because you're right. Like, efficient inefficiencies is sort of it. It's still there's sort of still a
it's like Kaplan's rational irrationality, which he's talking about totally different types of irrationality. Yeah. Actually, he's talking about the same thing that you were talking about earlier about the difference between having like transitive preferences and having rational expectations. He's saying like, oh, well, my transitive preferences tell me to not have as rational expectations because it takes time to like look up political opinions or whatever. That's basically what he's saying. Yeah.
Right. At the end of the and that would be a situation where there's like a known cost to incurring the calculation. But
Mhm.
if but right, like yeah, like the thing we're talking about is like sort of like that and then some, because it's like think about like I'm not just saying there's arbitrage opportunities out there in the economy, because if I were actually saying that, I'd be rich as hell, right? Like that's not what I'm saying. Like if the statement were it is known that there are arbitrages in the economy, then it's like, well, go exploit them. I mean, that same logic applies. The whole problem is not that there's this known, like layer of it's that at the limit, it's impossible to know whether there are arbitrages remaining or not.
Mhm.
And but that lack of knowledge, there are still people willing to make a judgment and undertake an action in the face of that uncertainty. That so it's it generates ongoing trading and dynamic movements within a market. But anyway, okay,
Yeah.
we should transition.
Okay. So
I don't know.
I have a connection to get to from this to some of the other stuff we were talking about. So the
I
question
unfortunately
of
need to take off in a couple minutes, so I can I'm
okay.
good for a couple more, but yeah,
Okay.
in like 5 minutes or so here.
We might blast past you a little bit too, if that's okay, Tegan, if we have a
Yeah,
couple other
that's
things
fine.
to say. But okay, but thanks for letting me know. But so I'm thinking a lot. The theoretical literature that I'm more interested in is like institutions
Yeah.
and institutional economics. And so this is basically a kind of issue that's been going on in institutional economics for a long time. So what you were talking about of when you make the choice, you actually change your constraints. That's something that it was really hard for Doug North to deal with, right? So if you read a lot of his early stuff and like the stuff as it's going on into the future, he says, okay, what are institutions? So, okay, we understand that like people could trade and like that's efficient. Okay, that's efficient. That makes sense. People general equilibrium, that's efficient. But sometimes they don't go there. Okay, well maybe there's like, oh well, you shouldn't trade that because it's wrong to trade that. And he says, okay, that's called an informal institution. And so trading that, you take, if the budget constraint is like or if there's like a hard transaction cost, or there's a risk associated with trading this particular thing because the government's going to attack you for it or something like that. We've got the budget constraint that's like a triangle, and then just like take scissors and just like snip part of it. Okay, so you've got another budget constraint now. The mathematics doesn't work out anymore. There's maybe 2 tangent points, but
Yeah,
like it's still.
you're not allowed now to get those bundles of consumption over there, because those are verboten.
Yes, yeah, or something like
Socially.
that. And then or something like if the XY axis is like different kinds of like different levels of like social things that you're doing, then you can like Swiss cheese it and take like a hole puncher and like punch a bunch of holes in the budget constraint, and then you maximize with this like Swiss cheese budget constraint or whatever, right? So and he's like, okay, well that does some of the work, but the problem is you have to like assume all of this stuff about how people act, like to get there. Like you have to assume that people are going to follow rules, and you have to assume that someone chose the rules, and how did they choose the rules, and from what set of potential rules did they choose those rules. And you just kind of have to like assume all of those things in there. So his early stuff is all about how like the relative prices shift, so people change their choices about which institutions to implement and stuff like that. And then they get and so you can see like, oh, well, the set of things are efficient with respect to the institutions, and then the institutions are efficient with respect to the environment of like the king or like whoever's choosing the institutions or something like that. So that's kind of like a partial equilibrium. But it like he basically tried to get like partial equilibrium in institutions. But once you try to general equilibriumize it, you realize that it's even more wacky than like a normal econ general equilibrium. And so that's where like someone like Greif comes along, and he says, okay, well, let's say that the institution isn't the constraint itself. People are constrained in a way. You can't fly, you can't do anything, right? So you have a constraint. This is your strategy set, and then there's other people trying to play too, and there's a number of potential ways that we can develop a Nash equilibrium with each other. And these positions where it's a the constraint, the way that he phrases it is the way that Nash equilibrium is formally defined too is that the each institution, each equilibrium is exogenous to each individual player. So this is how we do things is exogenous to me, but it's endogenous to the whole group, right? So, but still, it's not determined. The set of Nash equilibria is endogenous to the whole group, but which Nash equilibria we're at is not determined by just the characteristics of the payoffs and the strategies. So,
and it's sort of tying in these Schelling point ideas into this larger kind of like how do we explain the rules that we use.
And so he has this thing called, so when he starts talking about rules, he says, well, North had the rules and then you just follow the rules, right? So if you're doing the left side of the road, right side of the road game, North's answer is like, well, it's illegal to drive on the left side of the road, so people choose the right side of the road. Duh. Like you're just like cut off, and then the game that they're playing is just like one square. It's not even a game anymore. It's just they follow the rules. And then but Greif is like, okay, so this is the way he describes it is you can drive on the left side of the road or right side of the road, and you understand the payoffs here, right? And let's say that it's even Steven payoffs for left side of the road, right side of the road, right? And then he says, okay, you also know that the Department of Transportation declares that everyone should drive on the right side of the road. And you also know that everyone else knows that. And then he says, also suppose that you know that everyone else knows that Mickey Mouse says you should drive on the left side of the road. What do you do, right? And so the answer is a Schelling point, basically, because, well, the answer being the right side of the road, because in your mind, the Department of Transportation is a legitimate authority on this matter, right? But, which means what?
Yeah. Is that not because like the Department of Transportation has some capacity to punish you that Mickey Mouse is lacking?
That's assumed out of the model. Yeah. And that's understood to be like part of how it works too. So yeah, you could introduce things like that, but then you would have to introduce like the police as a player too.
Yeah. I'm just thinking the reason you would say the Department of Transportation is the legitimate authority or whatever in that instance is because like it's legitimate because like if I'm imagining the Department of Transportation, like they have the capacity to punish me. That's like why I conceive of them as being more legitimate than Mickey Mouse.
Maybe, yeah. Well, so and then that is part of the way that you interpret things. And then if you can conceive of a sub game where there's the police officers and they need to coordinate on which side of the road they're going to enforce, then they need to ask a question of like who's legitimate. Who's our legitimate authority, Mickey Mouse or the Department of Transportation?
Okay, sure. So there comes down to a point where force, you can't just do an infinite regress of force.
Yeah, it's incomplete. It's all
I think like you could always imagine just being at some at some ensemble of everybody's every individual acting within the system and say that like we could be on some margin, and at some point a decision to move away from that, even given whatever the costs and benefits. And I mean, because on some level Mickey Mouse could also punish you by not letting you into Disneyland or actually, I mean, like a lot of companies get punished by consumers for taking positions that are actually totally in line with, say, like the US government or what have you on
like with vaccines recently or something like that. If some company requires their employees to take vaccines, like, oh, I boycott them, or somebody would say that, right?
So, or Israel or something, I mean, there's
exactly. Yeah. And so, okay, but then this is where it gets even more interesting, because so North was not really able to convincingly answer the question of how do institutions change over time. So by 2005, he basically comes down to, okay, it's something about like ideas and beliefs and like and so he basically says like beliefs are the constraints on institutions, which are the constraints on economic behavior. And he's like, I'm a huge fan of North, by the way. And so I don't mean to say like pigeonhole him as just like Arrow Honda Brew of institutions. He knows that this is like weird, but he's also kind of going like, I don't know how to deal with it. So, but he basically says it's something like beliefs. Whereas but then when Greif tries to talk about endogenous institutional change, he does this other thing where he allows for like the payoffs to change, which makes me go like get a little bit sketchy. So he has an example of, let's say we're playing an infinitely repeated prisoner's dilemma game, right? But every time that and let's say like we have the sufficient discount factors that we can have the cooperate in perpetuity result, right? But let's say that we can add 0.01 to the payoffs for cooperating every time that we successfully both cooperate. So then not only can we cooperate, but then over time, the range of discount rates which would let us successfully cooperate gets larger, right? So he calls this a self-reinforcing institution, something to get stronger as it lives longer, right? And then he says, well, think on the other side of every time that we successfully cooperate, we get 0.01 added to the payoff for cheating. And then as time goes on, the window of potential discount rates that would let us succeed gets smaller and smaller. So if you allow like over time, there's a little bit of variation in which discount rates like my child has or my grandchild has or whatever, then you might see it break at certain points in time or something like that.
And it sounds like, like reinforcement learning in in machine learning or something, where like you want to if you want to like train an algorithm, you want the algorithm to basically you want the next iteration of the model to incorporate information about how it performed in the past, and to then update to get closer to what you want based on how you reward and penalize penalize previous models based on some score. I mean, but like I don't mean to bring in machine learning to make it more complicated. It's the same basic idea, yeah.
Okay, but
I'm gonna take off, guys. This is a great conversation. I'll catch the
talk to
end
you
of
later,
it when
Tegan.
it goes up on YouTube.
Yeah.
Great seeing you,
Great.
Tegan.
Good to see you
See
too,
you later.
Matt. Take care. Bye.
Yep.
So okay, but here's the way
Now
that
we can really tell everybody what we really think of Tegan.
Exactly.
Exactly.
Yeah. But so this is the way that I would want to modify the deficiency that I see in Greif with some of this incompleteness stuff.
Okay.
And it's you don't get a final answer, but that's kind of the nature of the problem here. Which is okay, so with the road game, right? Left and right, and other person plays left, and other person plays left or right is like the 4 environments you can find yourself in, right? And so when you develop a rule like always play right if they played right last time or something like that, this is the rule that you develop and that you apply to making a choice in each successive situation, right? And so it's kind of obvious that in this game, the 0-0 payoffs are when we get in a crash, right? Like that's what it means, the 0-0 payoff. And now in real life, where do most accidents happen?
Well, I guess I don't know, but I mean, do they? I like you. There's the statistic about people crashing their cars very close to their homes, like they're only like a
Right.
mile away or something.
Right.
What is it?
But,
What is it?
It's at intersections, right?
Ah.
And at intersections,
Well, of
there's
course.
yeah, at intersections, there's an infinite number of like there's left
I
and right.
wish
and
I had
people
said
go in the other direction. Yeah.
I wish I had said the roads. That's where most of the crashes
happen. Yeah. Well, yeah. Okay, yeah. But I mean, like,
but no, sure, intersections.
Yeah. So because there's so many other ways that we can interact, and I don't know like what you're gonna do. Even if I read like all the formal rules, even if I developed, basically the point is that there's no way that you can develop if there's an infinite number of situations that you can get in at an intersection, right? There's no finite set of rules that I can develop that tell me always how to respond to other people that I'm encountering on the road.
If there's an infinite number, also importantly, if there is an uncountably infinite number.
Okay, I
Like,
see.
and this is like a I mean, actually, I think that the way you've phrased it is still true in that approaching intersections or approaching situations where I go from facing a discrete set of possible outcomes, a finite possible like set of strategies that I could do, and a finite set of things that other people could do. If I as I'm approaching an intersection, and actually I love how you put that, because I'm sort of realizing that most of my driving anxiety is driven by intersections. Like it totally. I'm just thinking like, yeah, I'm not really too worried when I'm driving on
Or
a
shifting
straight road.
lanes too. Shifting on the highway, it's shifting lanes and exits and stuff like that, which is kind of like
Lanes.
intersections.
Anytime I'm approaching a situation where I'm going to have to change what I'm doing is difficult. And also, as I'm approaching those situations, if I'm going from a situation of like, well, there are there are 4 strategies that I could be undertaking right now, but then up ahead there is 200 or 1 million possible strategies I could be doing and other people could be doing, then I think it's still true that the problem becomes more difficult. Even when it's like finite but larger, right? I mean, because like that's just kind of intuitive, right? Like in a game where there are a million different strategies to choose from, that's more difficult for a person to grapple with than a game where there's 2 strategies to choose from. But then I think that the way in which like Gödel's incompleteness stuff like enters in, it has to enter in. Like basically, Gödel's theorem is basically like his sort of main tool in that theorem is a Cantor's as a Cantor diagonalization proof. He basically uses the fact that you cannot have a mapping from a countable set to an uncountable set, and that this is basically the fact that generates or makes possible Gödel's theorems about formal proof systems, which and I think what you and I would kind of like argue for is like, well, we can think of institutions as formal proof systems. You can think of institutions as you can think of institutions as sort of like again, this will sound very mechanistic, but as machines that deliver a value of 0 or 1 for allowed or not allowed, permissible, impermissible, guilty, innocent, or I guess guilty or not guilty. This strategy, this action is permissible in the society, this one is not, and using those to determine whether one should undertake or not undertake some action. And like when while that might sound like an oversimplistic architecture, the whole idea is that actually formal proof systems are like actually way weirder than they might sound at first blush, because when you face a because it can be proven that there are statements that you can make using the language of a formal proof system, which the truth or falsehood of these statements cannot be determined, cannot be decided using the formal proof system. You have to either add axioms to the formal proof system in order to get an answer. And I apologize because I'm like it's always helpful to like totally map these like map these concept analogies together, and I feel like I'm
Yeah.
bringing in formal proof system stuff
No, but it's
and not
important.
explaining how exactly it relates to institutions.
Yeah.
But yeah,
And so the thing with Gödel's theorem is that I don't know, I haven't studied it like formally mathematically. I've just read about it and how it works. But my understanding is that when you encounter the statement that cannot be proven by the axioms, right, then the way that you're supposed that concretely in that situation you're going to solve that problem is either by modifying your axioms or by making that statement itself an axiom, right? And then
yeah,
you
right.
run into the
Usually
same
that's what
problem
you do.
again. Yeah, you run into the same problem again. But if we're thinking about like this is something that North calls a non-ergodicity, where it's not, you don't treat the whole system as a whole at the beginning. You're actually like going step by step and kind of like thinking through it, right? Which is what we really are doing. We do have a set of principles that we start with, and then we keep judging situations and we output 0, 1, 0, 1 until we reach a particular situation that we can compute, and then we modify it there. That's the zone where we modify, right? So
And this would be like
then,
a problem you might approach would be like, which side of the road should we drive on? And you might think, well, institutions should be able to assign a this or that, answer to that question. What side of the road should I drive on? And the thing is that given a bunch of other axioms, you may not be able to assign that. And then what you have to say is, well, now a new axiom in our formal proof system is that you drive on the right side of the road. And you won't be able to prove that axiom using the other axioms. Anyway, you're saying it correctly. I'm just bringing it back to the road example. It's a good one.
But then the problem is if the option is either revise the axioms or add it as an axiom. If you choose option 2, many times you're going to have a lot of axioms.
Tons.
Right? So I think this is also a little bit related to Hayek's ideas about general rules and are like arbitrary choice of government, where you want a small set of axioms that are going to apply to like as many situations as possible. And so I think this might actually get a little bit of the heart of what people see as a tension in Hayek, where he talks about like the general rules, and then someone says like, well, is this an exception to the general rule? What as a general rule is a general rule? And so this is, I'm not saying that Hayek breaks down, but there's a limit to Hayek, right? Because you're going to run into situations where the general rules are not going to say whether or not the sovereign is supposed to or not supposed to do this thing, right?
Right. I mean, like, I think the way that Hayek appeals to it is like, I think he has like, I think basically when he gets to those questions, he starts using different tools to talk about them. He starts that's when words like evolution become much more sort of like present in his writing. Is we get to this point where, okay, institutions matter. Institutions in large part are about like mediating disputes in uncertain situations and sort of reducing uncertainty of participants, so they at least know what's permissible and not. And then forming what those are, he sort of then like begins to appeal again to, which I don't think is like wrong. It's just that like, I think he just kind of recognizes that I think he'd be like, yeah, and institutions also change and evolve, and different institutions are adapted to different situations, and in history all kinds of messy evolutionary paths are gone down and turned onto, and yet still this sort of like evolutionary like group selection optimization principle seems to hold, where like that which is fit for group survival tends to persist, and that includes not just like resource allocation outcomes in that community or like on the ground actions and whatnot, but also the rules that they use and sort of inhabit within.
So this is where I'd want to bring in something by James, actually, by William James, right? So he had an article where he critiqued Herbert Spencer's theory of evolution, or Herbert Spencer's idea of social evolution, right?
I've got to read that.
Herbert Spencer's like, okay, so like the Greeks, the essay is called Great Men and Their Environment, right? So the idea is like, okay, so that Spencer's concept of how evolution works is like, well, there's an environment and then like the fittest survive. So someone like Plato, right? You get Plato because there's a Plato shaped hole in the environment of Athens and he like fit, right? And then you get Alexander the Great for the same reason. So a great man theory of history is wrong because it's actually just the environment is like is shaping the question that, or shaping exactly the question, and then just random things happen and things move forward, right?
Which, by the way, is kind of like how Eugene Fama talks about winners and losers in financial markets. Like, he'll say like, yeah, in some sense, a Warren Buffett might just be lucky because somebody's got to be, if you just plot a distribution, there's going to be some investor who's, made money for 30 years and it's, in all likelihood. Anyway,
yeah.
Again, it's does the great man drive the market, or does the market drive the great men that we see?
Yeah. So James answers with the great men drive the market, but not entirely, right? So he says, okay, what you've done, Spencer, is you're doing Lamarckian evolution, but we have this guy called Darwin, and he did the real cool stuff that we all follow now. And the key thing in Darwinian evolution is not just survival of the fittest, but independent variation of mutations. The key word being independent, right? So which mutation is tested against the environment is independent of what the environment is. So whatever happens in the womb when the DNA is being produced for this new particular creature is a process independent of what kind of environment the creature is going to be living in, right? So like the way that I could phrase it is, if there's an environment that you'll only survive in if you have characteristic B or D, right? And so, but you can, by the process of however mutation, you can produce A through E, right? So if an A is produced, they die. If a C is produced, they die. If an E is produced, they die. But whether or not a B or D is produced, that's determined by the independent variation, not by the environment, right? So, and then whether or not a B or a D is produced, let's say they're a predator or a prey, and then this changes the next set of environments. Maybe now E is possible because B was selected last time instead of D. But if D was selected, now A is possible and E is not possible, right? So the actual pattern, so there's something independent of the environment that's making part of the selections. So it's a back and forth relationship. And I think you could think, if you're putting this back to institutions and game theory, the matrix of payoffs is like the environment. These sets of strategies are Nash equilibria that can potentially survive, but that doesn't say which one we get at.
Yeah. Well, I mean, it's like, I think maybe another way to put it too is that like the environment explains the mutations that we see that persist, but the actual generation of these mutations isn't something that's literally caused by the environment. Like those mutations need to sort of arise of themselves or from some other process. And like, the environment, the environment then will sort of enable some to succeed and some to fail, but the mutations have to like be there beforehand, before they, I don't even mean like time sequentially necessarily. It's just yes. They have to be sort of distinct. Yes.
So, and one of the people that they're arguing against just in their intellectual environment is also, I think it was Laplace, who was developing, no, it wasn't Laplace, it was someone else, but they were related to Laplace, developing like the average man. So we're going to do all of social science with like the average man or something like that, and like testing them in different environments. But they're like, no, you have to know what's different between different people. And so then Peirce has another essay, which is one of the most bizarre essays I've ever read. And I think it's so juicy, and it's called Evolutionary Love. And so he distinguishes between, and he has these he basically wants to apply Darwinian evolution to metaphysics, and he wants to like replace metaphysics with like something about evolution. And he's,
You know, like the mid to late 19th century, like what a time. I mean,
wild stuff was
like
it was a transition era.
you could legitimately write an essay called Evolutionary Love. I mean, that's really
Yeah. But what he does is he distinguishes between three types of evolution. Tychastic, which is like Tyche, the Roman goddess of fortune, right? And he says that's what Darwinian evolution is, right? So there's the environment, and then there's random variation, and then you test against it. And then he has enancastic evolution. I don't know what the root of that is exactly, but he makes up words. He loves making up his own words. So he has enancastic evolution, which is mechanistic evolution from part to part, where all of the parts in this period determine the next part. So if you think of like a physical system evolving over time, or the example he uses is Hegel. Hegel's system is like, we're in state A, and A always leads to B, and B always leads to C. So Marxist social evolution is enancastic, right?
And like it would almost be like you know, like in a biological context, it would almost be like the next offspring, you know, sort of like decides to fit itself to the environment based on what its parent learned.
Yes.
And it's that it's actually like responsive consciously.
That's closer to Lamarckian evolution then. Or the idea that what their choice is of like what my genes are going to be is dictated by the environment somehow, right?
Yeah.
But then the third one is agapastic evolution, which the root is agape, which is the Greek word for the love of God.
The love
right?
of God. Yeah.
And so he's like, and that's when he's just like, okay, and that's the big one. So it's like, it's somewhere where like we evolve because like we love different things and different parts are attracted to each other or something, and they're trying to form into patterns. So that's closer to what you would properly say is how like a human environment would work, where it's not, you can love different things, but what you love determines what choices you're going to make, but also the environment of what everyone else loves is going to determine where you guys revolve around or where you rotate around and stuff like that. So
yeah, I mean, like it and these distinctions are really important because they kind of get to the heart of like, what impact does man have on his environment? Like what impact, does, you know, does man have free will? I mean, you know, are we like these really are fundamental questions. Like, are we determined by our environment? Do we exist in a state of like in a situation where it's like, you know, historical you know, determinism? You know, should we be Calvinists, or should we be Catholics? You know, I mean, these really do and it's also like it's not just interesting philosophically, theologically, esoterically like that. It's also like these different ways of conceptualizing of these processes lead to, well, they actually lead to like empirically different outcomes. Like they lead to real, like these aren't just different theories that are invariant to the empirical reality. They really do offer like, you know, different views on what you should expect to see and not see occurring in systems.
And what you should do, how you should respond to things too, most importantly, I think.
How you should, and sort of yeah.
So
I need to read a lot more of the American Pragmatists.
Yeah, oh, they're what I invested in.
Yeah.
So yeah,
it shows. It's like, you know,
I well, mostly James. I really have read little to no Dewey and then some Peirce. So, but mostly what I've read is James. So I plan actually soon to read more Peirce. Over break, I'm going to read one of the essential Peirce volumes, which includes like the evolutionary love article is like part 5 of 5. So I've only read part 5 of 5. And he also goes like, by the way, this is the theory that's in the Gospel of John. And you go like, oh, okay. and he rips into economists in that essay too. He's like, economists don't get this. And I was like, okay, all right. Oh, by the way, this is something you would be interested in. Is Peirce was one of the first people to develop a mathematical model of insurance companies.
Oh, really?
Yeah. And he used the mathematical model of insurance companies to try to describe some of his ideas in pragmatism.
I mean, I buy that. I mean, like,
Yeah.
like the philosophical departments in the American Academy at that time were,
Yeah.
that would be really interesting.
There's some articles by James Whibble, like summarizing how he used mathematical economics and stuff like that.
Huh.
Yeah.
I'd be interested to see more about that, because like it's very it's a really interesting moment in economic history too, where like, Alfred Marshall had happened. I mean, the marginal revolution had happened. And you had people grappling with like new tools and techniques to analyze these things, and like people really thought very deeply about the meanings of these models at that time.
And we don't anymore. No one does anymore.
Hardly anybody does. Yeah, no, it's true. Hardly anybody does. And it's like, it's also like, you don't need to like get to get the pubs. You just don't need to. You don't need to. And it's a shame. I mean, like when you read some things by like Slutsky, the Slutsky of Slutsky's equation, Slutsky's which actually I hope my memory is serving me correctly here, but Slutsky's equation basically describes the relationship between like the endowment effect and the substitution effect.
It's an attempt to eliminate the income effect from some kind of price change, but it doesn't do it entirely. It does it in a different way than Hicks does it.
Right. So you get this Hicksian demand, but you get a slight variation on it to remove the income effect of the endowment effect, or account for it somehow. So like interesting stuff. Every PhD micro student sees it, learns it, memorizes it, knows it, inculcates it. Slutsky wrote like some really crazy, outrageous stuff, and he was living in like Soviet Russia at the time, and like it's just, I don't know, it's just such an interesting era, and the probability theory was pretty new, and you could really ask. And anyway, we're talking about the American pragmatists. There's another, I guess there's two other things, right? So this paper that I'm working on with Cameron Harwick, one, we're trying to grapple with a lot of this evolutionary view of institutions stuff from a Godelian. I don't really know how to say Godelian, because I would say Gödel. Well, it's Gödel, but then do you say Godelian?
Godelite.
Godelite?
No.
A Gödel-like analysis.
Gödel inspired.
So like we're trying to do some of this to say like that, if you have an institution, there are disputes or problems that this institution won't be able to decide or address, and so therefore what people tend to do is add axioms or form like supervening institutions that govern the institution from within, like from without, and that you can, so like think about like federalism. There are a lot of but it's not so straightforward as like, well, everything that a city government can't do, a state government does, because there's clearly a lot of like overlap in responsibilities and rights among different like levels of government and so forth. And you can kind of imagine, the American judicial system as conceiving it as sort of a thing where, like, well, the legislative branch, they basically make the law, but when contradictions arise in the law, or when there are disputes that arise that the law can't like handle or can't address, or there's dispute about how to properly interpret the law to address such a dispute, then you get this supervening institution of the judiciary, the Supreme Court, to assign something, and ultimately there's sort of like a buck stops here element to the process, whereby you just say, and at this point it's because I said so. So there's ultimately like there kind of has to be some sort of authority, threat of violence, some kind of immovable force on the other side of that, but which is also like, but of course, like, such bucks where such stops where the buck would stop are themselves contentious, right? So people are competing to be the authority where disputes finally get solved at, or where disputes about disputes and how they should be solved get resolved. So it's a challenging problem, because like there's always you could just always add another layer to some kind of institutional, just always think of like, oh, you have this problem, establish a supervening authority. I would think about that in a modeling context as another axiom in a formal proof system, or a formal or a meta formal proof, like a formal proof system about formal proof systems. Or like a formal, which is very possible to do. Like it's part of
which is like political. We call that political philosophy.
We call that political, right? Exactly. Yeah, it's like yeah, you're right. And so also that's the thing, is like sometimes this can feel silly, because like, what are we saying? It's things that people have said many times over about political philosophy. So it's not exactly new, but it is kind of a new way to interpret and organize and think about which political philosophies and conclusion and which ways of formulating the problem are most amenable to the ongoing dynamic evolutionary process that you kind of see and have to admit at the end of the day is present. So there's two things I kind of wanted to mention, right? Is one thing that Cameron and I have talked about a lot with that is this idea of the noble lie, which is which is an idea that is sort of attributed to Strauss, and Leo Strauss. And so like the idea there being that you have to admit that at the end of the day, decisions are either appealing to like some higher order authoritative institutional structural rule. You like why is this good and this bad, or this legal and this illegal? You would answer that question by appealing to whatever the system of rules is present. But then if you wanted to ask, well, why is that system of rules the system of rules? You could then keep appealing to other systems of rules and tell a story about how they came about. But Cameron and I are kind of like, we're thinking that like this Straussian idea of the noble lie is kind of an interesting sort of it's an interesting way to grapple with the problem once you reach that like sort of meta level, because it has to stop. it like historically, ongoingly, it doesn't have to stop. But at any given time, you do see something like stable societies persisting, at various times. And if a tribal society that's existed for thousands of years has some institution that doesn't like appear to make sense, but is something that everybody follows, and there are a lot of instances where people are following institutions that they sort of like know to be inefficient in some sense, but which like rather than saying, well, all institutions are inefficient in some sense, and this is what we have, and it's like driving on the left side of the road or the right side of the road. Like, who cares? I mean, you got to settle on something at the end of the day, and so this is what we do. That's not a very like motivating like story that a person living in a society would like to tell themselves about, like why there are so many people of a certain race behind bars, or why there are like certain, why there are certain traffic rules you can follow and others you can't, or why we elect the president with an electoral college or something. And what the idea that Karen brought up to me, and I increasingly find it appealing, is that at a certain level, you have to make up like a cosmological story about how like everything works, and then basically people eventually appeal to that, and they appeal to these like these fantastical mythical stories in a way that sort of allows you to close the loop, and allows you to say, and why that institution? Well, that institution was ordained by God, and our intention is not to be like, condescending to like, I believe in God. I mean, like I'm pretty sure from conversations with you, Marcus, you do too. And like, it's like I don't find anything about that like particularly ridiculous or anything like that. It's just that, well, in addition to being, a kind of like revealed theological truth, like it's also like a useful social technology that allows people to. Anyway,
the question is particularly about organized religion too, and like that's like more poignantly where that kind of question attack, not theism in general, I suppose, right? But so
I think that's right.
So that is totally fascinating. I don't want to say I totally agree yet, because I don't know technically analytically what it means, but I'm also very intrigued, and I intend to talk to Cameron about it. And speaking of organized religion, we've been going for about 2.5 hours.
Oh my God! Let's get to the church history stuff. My God.
Yeah. So
yes.
I wanted to tell you that I've been thinking about how to apply these ideas to some stuff in church history, and I actually got this thought from connecting in class this incompleteness stuff with the contract incompleteness stuff in Williamson. So Williamson and Tedelis have a paper, which is, will our firm be hierarchical, or will we do things like on the market based on two things? How much contract incompleteness is there, which they reduce to like a probability of like probability, how likely is it, or are we going to run into a place where our contract doesn't define what we do, right? And then there's like a good payoff, bad payoff. So it's like very simply modeled, but and then asset specificity, which is just generally things that can generate a holdout problem, right? And my idea is that and so the more asset specificity and the more contract incompleteness there is, the more like the better hierarchy is a solution, because when you run into those situations where the contract is incomplete, the hierarchy can like adapt to the situation better, right? Or if the person in control can like in certain situations like do certain decisions, you solve these, like you solve incentive compatibility problems about like what choice are we going to make, because you don't run into like Condorcet paradox issues too about like when you run into these new situations. So a hierarchical system is better at managing those situations, right? But there's also the downside of a hierarchical situation where who is going to be your heart, your head, and are they going to be a good, figure at the head or something like that, right? So the idea is that those two principles or qualities, asset specificity and contracting completeness, apply very well to churches. And I'm still unclear how much I want to say that, talk about like the religious good, like church is a firm that provides a religious good, like, but I think that functions for now. So that the religious good, given that you have certain beliefs about what is a properly provided religious good, is very much asset specificity, right? Something like that. And
there's very little else that churches could be used for. There are some things, right?
Yeah.
I mean, like concert halls, whatnot, but
yeah, but well, my idea is that the asset is specific in a flip sense, in that it's specific to the consumer, like this religion, or if like this religion is where you have to go, you have to believe from this particular set of revealed doctrines are the true religion or something like that, right? So but then there's obviously, with something like Catholicism, or Orthodoxy, there's a one true church that you have to go to, and the idea of communion, this is the only authentic apostolic communion, and stuff like that. So, but
yeah,
then,
so I mean, like not literally like church property and assets so much as the like whole ensemble of like services, products, things,
yes,
ideas
that the church provides,
rituals.
Yeah.
Yeah, totally.
So, and then if joining the church means that you're also assenting to this set of doctrines, and that the church is going to, being a part of the church means following the doctrines of the church, there's going to be a list of doctrines, a finite list of doctrines, and an uncountably infinite number of scenarios where you're going to run into things that the church doctrines just aren't going to tell you what to do. So this is, I was calling this, instead of contracting completeness, creedal incompleteness. So every given creed of the church is incomplete to every single future potential situation that you can run into. So historically, in the first millennium, the seven major creeds that are not, they're not seven major creeds, the seven major councils, which of the first two developed the Nicene Creed, and then the Niceno-Constantinopolitan Creed, which is the one that is used in churches today,
right.
is they ran into those situations because of these anomalies where I thought that we have never considered this doctrine before, and some particular person,
is it heretical or not?
Yeah, is it that? And so that, like, Arius, who inspired the Nicene Council, said this thing, and then everyone's like, well, we haven't clarified specifically that that's wrong, but we always have agreed that that's, we don't believe that. So what the council did was renegotiate the contract slightly, not changing exactly what they believe, but further specifying the contract of what it means to be a part of the Christian church. And so that's what creeds do over time, is further specify the contract. But at the same time, if you don't have a hierarchical system, you can't negotiate, you can't keep those things together better, right? It's more likely that you're going to schism. So the idea is that churches that don't have a hierarchical structure are more likely to schism in the face of new doctrines that they can't process. So in the last century, you've had this, you can think of women's ordination and just like multiple topics about homosexuality, obviously.
Sure.
So, and just churches, so the Catholic and Orthodox Church can pretty much process this, right? There's obviously a lot of tension, but they're pretty much still decided. The Catholic Church is still pretty decided on contraception and stuff like that, right? So
and the way that they would the way that they would engage with these issues would be with a further elaboration of existing belief. That further elaboration would be executed by this hierarchy.
Yes. So, so there's a double problem. The hierarchy solves this problem, but you also need to find a way to check the hierarchy. So that's to make sure they're not just innovating. The hierarchy is not innovating themselves, right? Which is what I go to an Orthodox church. I'm not formally Orthodox.
Oh,
but,
interesting. Okay.
But there's a weird thing of this is where Orthodox don't like what the Catholics did, because in 1054, the Pope was like, hey, I'm going to change the creed, right, slightly. So, and everyone's like, you can't do that. And he was like, well, I have to, because there's all these new heresies in Europe that you guys aren't worried about, and I'm worried about them, so I'm changing the creed. And then that led to the schism. And so this is definitely my bias, but then my understanding is that a lot of the further innovations of the Catholic Church came from no one checking the Pope, from there being no check on the Pope, whereas there are checks on all of the Eastern patriarchs. That's one reading of it. I don't know the history well enough to say that for sure.
How are there more checks on the Eastern or on Orthodox? Like when you say there are more checks,
just in the sense that if they want to do something like that would be considered an innovation, right? The other bishops can call them out on it, and and they could call some kind of synod or council and excommunicate them, right? And there's also the point of like, so that they don't really have one person on top. They have there's the ecumenical patriarch, they call him, which is the patriarch of Constantinople, who, and his only special role is his only special role today is he's actually taking the role over from the Byzantine emperor, which is the role to convoke councils, right? The role to say, okay, we're going to have a council. That doesn't mean he gets to decide what they say, but if he says we're going to have an ecumenical council where everyone is invited,
and this is sort of a part of his title, even.
Yes.
Right. Is a
yes.
Is an appeal to those old imperial titles. Yes. Yeah.
And so, and then with later Protestant churches, either they're not hierarchical and they have rapid mitosis, basically, like Baptist churches, right?
Which is very easy to observe. I mean, you know, all the evangelical, Pentecostal, all of these, I think you and I would agree, heresies in the American continent, but in Europe too. You know, there's you can observe it pretty easily. There's a lot of schism. You know,
but there are a number of Protestant churches that are relatively hierarchical.
True.
So like the Anglican Church, or to some degree the Lutheran Church, or to some degree the Methodist Church as well. But then
there have been stuff with Methodists recently, though.
Yes,
like there's been almost kind of a minor schism in the Methodist Church over some issues surrounding homosexuality.
So about ordination, I think. Maybe even the having marriages. I don't know if they allow that or not. They've had women's ordination for a long time. But then the hierarchical Protestant church is if you call them a Christian church, is the Mormons, which are super interesting as well. And they have been very careful about negotiate. Their hierarchy is always changing doctrines and stuff like that, right? So
okay.
So
and they're basically responding to people who would otherwise want to schism. I mean, is one way to think about it, I guess.
Yeah, you can think. This is just from the Book of Mormon movie, but so I don't know it for sure. But or the musical, where they only said that like Black people can join the church in the 70s or something like that, right? Yeah, and the proposition is that the president of the church can speak directly to God or something like that. But yeah. Anyway,
and of course stuff about monogamy and so forth has been kind of settled there for a while, but
that, in my understanding, that was a conscious decision by the Mormon Church to say we're not going to do polygamy anymore, right? And so the Mormons that do polygamy are heretical to the formal Mormon Church, and that was part of the Mormon Church negotiating with the United States government. Actually, I think the government was like, if you're going to be a legit religion, you can't do this. You can't do polygamy, right?
Well, that's another angle on this, though, too, right? I mean, there's often throughout history a good deal of like interaction and crossover of roles and like shared duties and responsibilities and rights between states and organized religions, and like just the cost of negotiation between a million minor churches that all consider each other heretics. The difference between negotiating with that kind of a situation from a state actor's perspective and negotiating with one large
Hmm.
entity are, obviously very different. And I mean,
Hmm.
there's been a lot of I mean, even back in like,
Hmm.
like the old ancient Greece, who made the money in ancient Greece? It was the money was minted at the temple. It was a and I mean, the historical record is not complete by any means, but yeah, the idea that there were shared duties between the state, that might be sort of a totally different angle than the one than the one that you're pursuing. I just think it's
It's
something
related
to bring
somehow
up.
for sure.
You
It's
know?
related somehow. Yeah. Yeah. And then, okay, and then what you were saying about the difference between being able to negotiate with one religious authority and then a plurality of religious authorities. That's the story that Johnson and Koyama tell about. I don't know if you've read that book. That's one of my favorite books in econ. They're both professors at Mason, Noel Johnson and Mark Koyama, and they do economics of religion and economic history. And the
Oh,
book
you
is on.
recommended me a book by them, or by one
Yes,
of those
yes.
authors. Yeah, yeah.
Yes, yes. It's and their basic idea is in the medieval era you have a equilibrium, which is they describe as like a self-reinforcing Greif kind of equilibrium, where the state enforces religious policy for the church and the church legitimizes the state, and they kind of like have a mutual
Hmm.
beneficial thing like that. But then when the it all explodes, then it becomes that then the only way that the state can negotiate with the religious authorities is by developing rules that can process, like, I mean, there's many years of wars of religion, right? It's not just
Yeah,
like they all switched one day and they're like, okay, Protestants are allowed now too, right? After
yeah,
Protestants
yeah.
like raised their hands, right? it's it,
Definitely not.
this is the non-ergodic situation, right? Is the wars
Yeah.
of religion. So they've flipped the switch, and then or they don't flip the switch rather, but they need to develop rules which can figure out how to be like a bare minimum and kind of constrain the authority for a diverse population. And this is like the origin of, well, particularly religious toleration, but generally liberalism, right?
Yeah, definitely the cauldron, out of which that emerges, totally.
Yeah.
And like uh yeah, and like there's competition among states occurring at the same time too, right? So I mean, like, England is kind of integral to the history of the Protestant Reformation. Like, its decision to split off from the Catholic Church
Hmm.
was a big instigator of something that was already happening, but a big furtherance of that. And on the one hand, it might seem like, well, I have to no, I think that some of this, I mean, generally, I just think that like economic theory can be brought to the table to analyze the incentives and constraints faced by these different by state and church actors in general. But like, it's not but I think neither you or I are painting like a simplistic picture, right?
Hmm.
It's like, well, it's not just like this one state and it's got to deal with a bunch of religions. There's a lot of states and a lot of religions, and they don't all recognize each other. Notice, right? Not all states recognize each other either. You know, empires, and the splitting up and breaking down of the sort of imperial order that was brought about by the rise of liberalism, but also the world wars and everything. A lot of this kind of comes down to negotiation costs,
Hmm.
and to well, a lot of other things, but I think that's
Yeah. The question about Henry VIII is like, okay, so could a king of England if they wanted to earlier have done what Henry did, right? Did the potential equilibrium exist? And then, so then the question is it possible that what Luther didn't shift the constraints or the payoffs of the British king, but shifted the focal point for what everyone was going to coordinate around, right?
Well, he could do both, right? I mean, he could change the constraints and change the payoffs, and therefore change the equilibrium point. But unless there's a finer distinction there I'm missing. But
I think yeah, I'm not sure. That's just a back of the head kind of thought, but yeah.
Well, no, I think the question you're asking, right, is like, could a previous king, like, would that have been a sustainable equilibrium for at some previous era? And probably not, right? I mean, it would have been. It was already totally outrageous for Henry VIII to do that, and I mean,
yeah,
the subsequent costs, of that were immense within England. And on the continent with all the religious wars that they engaged in.
I mean, there was a minor version of that with the Avignon papacy when the French king decided, like, hey, we're going to have a different church, and it lasted for a little bit, but then the schism was healed.
Yeah, right. And I think Catherine of Siena, played a big role, which by the way is interesting because maybe that's a little problematic to the hierarchy story, by the way, because Catherine of Siena is very outside the church hierarchy and kind of a critic from without.
But she's when we were
she's a respected critic from without.
But. Yes, when we were at IHS, did I talk to you about the monastic stuff that I'm working on?
Yeah, but yes, I do. But jog my
idea is that, okay, well, if the highest authorities in the church, they can't establish a full credible commitment to that they're trustworthy. If there's an external source that is trusted that has a credible commitment to being trusted, which is like the monks, then they can, if they legitimize the bishop, then you have a credible commitment that the bishop is legit, right? So Catherine of Siena is basically that for this problem, right? So people trust her judgment, and because if it's two sides of the ring, you're like, yeah, they're both going to say that they're the legitimate pope.
We need an honest broker.
Yes, exactly. And monks are honest religious brokers, external to, but they're part of the same system, right? The most honest religious broker is like God or whatever. So that's why you have to trial by ordeals or something. But
sure, yeah, and I mean, people and people will appeal to that on opposing sides of any debate, frequently, which evinces the desire for an honest broker. Yeah, no, totally. I mean, yeah, so like they're without and the monastic day is probably more true than in other words, what I'm trying to say is it's probably most true at the inception of a monastic order. And then, but monastic orders themselves, of course, become, consolidated into the larger power structure or whatever. But then Luther comes along and like something very different happens. Right? He's at first a critic from without. I mean, he's a critic from within, but somebody with not a didn't have a he was a scholar priest in a kind of backwater of the of Christendom, and something different happens, and I guess I'm thinking, why was that? Without just kind of to myself and also to you, I guess. Yeah.
One of the common stories about, and this is what Jared Rubin has worked on, is that that Luther had the printing press, right? Whereas so that new mutation had the ability to spread faster, right? Before it was even checked by whatever other kind of environment that it was in. So the ability to spread ideas faster changes which ideas can be succeed, because some ideas might catch on if they spread fast enough, but if they don't spread fast enough, they get squished, right? And that's just potentially what revolutions are generally. Like a lot of revolutions are generally.
And that was a super central part of his um of his whole deal, right? Was like, let's print a Vulgate version of the Bible.
Mm-hmm.
So it's like, yeah, that technological, yeah. No, I'm on board with that. And I mean, even like ancient Rome, I mean, the sort of the slow demise of ancient Rome can kind of be, viewed through the lens of the the challenges and costs created by having to mediate between and govern disparate religious groups.
Yes. And so they have to develop that civil law that does apply in as wide number of areas as possible. If I understand how the Roman law worked, I don't know much about Rome, but
I don't either. But I mean, there was like, or I don't know much about
they
like
kind of
Roman
played
law.
a strategy. They played a strategy that was something like, well, let them do pretty much what they want and keep their culture as it is, as long as they pay a certain amount of taxes. And it was like an absolute number. So like when the Romans hire a taxpayer, that taxpayer can do whatever that tax collector, sorry, that tax collector can collect taxes in any way that they want, as long as they reach a certain quota. That's why, like in the Gospels, the tax collectors are so thoroughly hated, because they were
Right.
exceptionally unfair, much more than a modern tax collector.
Yeah, and they wielded so much discretion in how they were going to collect.
Yes.
And I mean,
and they skimmed likely.
Well, yeah, and that's the other thing, is that they had right. Now that was a part of that's a cost of awarding that discretion to somebody. But yeah, no, I'm really fascinated by these topics, especially because, like, economic theory is supposed to give us a set of tools, or like a way of thinking about motives and action that allows us to interpret past history. And like, so much of past history has to do with organized religion. It would be sort of a useless science if we were totally unable to think about religious institutions in these terms.
And it's really crazy because that's people in econ history, economic history of religion is like just the floodgates are just being broken. So
yeah,
there's so much to investigate. Yeah. And then with respect to how religion plays today in politics, people are always, it's obviously related, but people don't know how to make it related because it's not formally related, right? So
right.
Yeah. Like Biden's Catholicism, people mention it, but then you're like, what is it? Like, because he's not advocating for, he'll say something like, I think abortion is wrong, but I think people should be allowed to do it. He'll say things like that, like very quietly. But so, and how do people think about that? I don't know. And then how does there's a whole question about how the church enforces against him as a Catholic too. And people have been bringing up questions like, how does the Pope get to like decide things about American politics? And you go like, dude, have you heard of the Middle Ages? Like,
yeah,
like these are questions that people have been worried about for a while.
Or like just rewind like 60 years, and like when John F. Kennedy was elected, like the press would frequently write articles about like this guy's an agent of Rome, the Rush Limbaughs of that day, were all over that angle on him, and it's kind of remarkable. It's like, on the one hand, you might sort of think in the last 50 years, very little has changed about the Catholic Church. I mean, on the one hand, a lot has changed. I mean, I think you or I would know that, but you might sort of think, well, in the grand scheme of history, not much changed about Catholic institutions. I mean, we know, Vatican II changed a lot of things. There really has been quite a shift. But one data point to say that actually a lot has happened is that the American voting populace thought very differently about electing its first Catholic president versus electing its current Catholic president.
Which I think is I think he's the only other one.
Yeah, I think that's right.
Yeah. Yeah. So, yeah, this has been great.
I'm so sorry. This is like, we've been talking for so long. I know it's
but
I had a blast.
There's so much to dig into, and I'm sure we'll do something like this again sometime. And is there anywhere that you'd want to shout out, like that places that you post things, or I could put you a link to your whatever in the description. Sure.
I mean, I have a website called sociolegalfictions.wordpress.com, or rather, WordPress has a website called But so I have a few essays that I think are cool enough to share, I guess, there. But as far as other shout outs, no, there's a long list of things coming to mind, so I should just shut up and say,
okay. And you can just send me a list and I could put it in the description or whatever.
That sounds great. Yeah.
Okay. Anyway, this has been Matt, and we'll see you guys next time.
Thanks a lot, Marcus.